The reality is the AI boom is real.
AI has the potential to be very important, but no technology gets adopted in a straight line.
We need to see a heck of a lot more, particularly given the amount of spending that is going to be done over the next couple of years. I don't think the spigot turns off in 26 or 27.
You are seeing a broadening out. A most preferred way to pay structural growth is through tech.
For the moment, the trajectory is very much towards corporates still being in a relatively better position.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, threatening to melt up. The S&P 500 at all-time highs on a 7-day winning run. Following AMD inking a blockbuster chip deal with OpenAI. The Citadel billionaire boss, Ken Griffin, says we're definitely on a sugar high. That rally this morning, taking a breather.
When it comes to AMD, Jonathan, massive moment. We will look back at this moment and say, was this a decisive moment for AI and the build out, or was this potentially the start of what people are starting to say, it's feeling sugary and we are on a high? Another moment of a circular market where AMD is going to help OpenAI with their compute and their strategic build out, and then OpenAI gets a stake in AMD. So if AMD does well and OpenAI does well, then they both do well. But if they don't, this is where it starts to get a little bit unnerving.
That stock up big time in yesterday's session, up again this morning so far by close to 4% in the pre-market. All eyes on a gold rally as well, very close to 4K. This is what Ken Griffin of Citadel had to say on that gold rally. Really concerning. People are looking for ways to effectively de-dollarize.
If you don't want to hold U.S. dollars, you're a little bit nervous about U.S. treasuries. Right now, we still have it's the seventh day of a government shutdown, but there's always this policy uncertainty emanating from Washington, D.C. What do? You go and hold on to gold. But this has been a story even under the Biden administration. We first saw the big sanctions when it came to Russia and going after their central bank assets. You look at central banks around the world, they're saying, where else can we put our money? We feel safe in gold. And now investors are doing it as well.
39.56 on gold this morning, just short of all-time highs. Fresh records in the last 24 hours once again. Let's pick out a single name in the pre-market, one you might not have heard of. Trilogy Metals. In the pre-market, higher by 171%. Another company this government is taking a stake in.
And this is just a question I have yet again this morning. Are we seeing state capitalism the way the Europeans did it in the late 1960s, or is this really a national security concern? When you look at where this government is taking stakes, you think this is a national security concern in terms of why they want to go after companies that have assets to rare earths, that have assets, things like copper, that can be huge for not just the AI build out, but critical infrastructure and supply chains. And the latest one being Trilogy.
Is this the strategic sovereign wealth fund slowly coming together before our eyes?
Potentially. It's coming together in real life. They don't really know what it is yet, but it's coming together in real time.
Massive rally on that name. More coverage of that story later in the programme. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research with stocks on a tear. Kit Juckes of SocGen as fiscal concerns continue to mount, and Neil Dutta of Renmac on the case against the AI productivity boom. We begin this hour with stocks inching lower after closing at another fresh record high. Ed Yardeni of Yardeni Research writing, everyone's on the lookout for signs of an AI bubble, yet the market continues to climb the wall of bubble worries. Ed joins us now for more. Ed, welcome to the programme, sir. Two-part question. What's a bubble and what is this?
Well, at this point, I think we're getting into bubble territory for sure. We've got the forward PE of the S&P 500 around 23, and the peak during the previous tech bubble in the late 1990s was 25, so we're getting close. But you know, the earnings story has been phenomenally strong, particularly this year in the first and second quarters. Who would have thought, with all the commotion coming out of Washington? And it looks as though the third quarter earnings season, which is about to start, is going to be very strong as well. We're expecting 10% year-over-year percent change. So the earnings are actually there to continue to drive this bull market higher. But I wouldn't want to see the valuation multiple go any higher than it is right now.
And that earnings story, part of the reason, part of many reasons why a lot of people are still looking for the potential melt-up. Typically, a melt-up is a risk people want to own. Is it a risk you want to own? And are you willing to keep your bets on this market quite concentrated to take advantage of it?
Well, you know, I think it hasn't been all valuation. The reality is, again, it's been a earnings-led melt-up, which is fine. I don't have a problem with that. And that's really not a melt-up. The fundamentals are actually there. And oh, by the way, if this whole AI thing turns out to be a lot of hype, and the companies that are spending all this money on AI infrastructure have to kind of slow it down, and it's not exactly the end of the world. I mean, these companies are using cash flow to finance this. It's not like 1999 where telecommunications companies did seller financing and there was a tremendous amount of debt, because to do that they borrowed in the junk bond market. So there's a lot of credit in the bubble back then. This time around, it's cash flow. And if they have to slow it down, their profits are suddenly going to look even better.
Well, Ed, two of those companies, AMD and OpenAI, the AMD CEO, Julie Su, said this yesterday: the more OpenAI deploys, the more revenue we get, and they get to share the upside. Does it concern you that this is so circular? Yeah.
Well, you know, I'm thinking of putting a few $1 billion into OpenAI and doing business with them. Everybody's playing the game here. So yeah, the circularity of it has got the markets really spooked. The markets got spooked about AI back in January, remember, with DeepSeek. And so this is kind of the latest fear that we haven't seen anywhere near the kind of correction we saw with DeepSeek. I'm not that concerned about it. I think there is a lot of capital spending going on, and these companies, you know, unless they're misinformed, which I kind of doubt it, these hyperscalers, they know what's going on, and they know that the capacity of their system is getting stretched, is getting pushed by everybody using AI and trying to figure out how to use it.
Jeff Bezos said this week as well that investors are just having a hard time in the middle of excitement to distinguish between the good ideas and the bad ideas. How do you distinguish between the good and the bad?
Well, I'm no better at it than anybody else is at this point. I'm going to assume that the hyperscalers, who basically are Magnificent Seven kind of companies, know what they're doing, and they are. You know, a lot of the investments are data centers. It's not like, you know, right now there's a lot of mystery about where the spending is going. And the data centers but themselves are actually, the data is available monthly from the construction report that the government used to put out when they was open. But that showed that data centers were running around $40 billion. And that's at an annual rate. That's times 12. That's not a terrible number. Now, of course, once you build the actual structure, you've got to stuff it with all these semiconductor chips, and that money is being spent. I don't think this is money down the drain. I think this is for real.
Ed, there is an additional dimension that makes this rather strange, that we have the US government picking winners at the same time. Intel, Trilogy Metals, we have OpenAI picking winners too. We saw evidence of that in the last 24 hours. Does that change your approach to stock picking, Ed?
Well, you know, my attitude towards Washington is it's amazing how well the economy does despite Washington. It's amazing how well the stock market does despite Washington. I don't like this state capitalism, as you rightly called it. It's not really necessary. The free market should be able to decide who the winners are and who the losers are. So it's more noise coming out of Washington. The signal we're really seeing the fundamentals is the economy continues to be extremely resilient. That's really the word for the economy. The past 4 years, we've had the most widely anticipated recession of all times that didn't happen. I didn't think it would happen, and I think that's why the valuation multiples are high, and it's why earnings are so remarkably strong.
Ed Yardeni of Yardeni Research. Ed, good to catch up, as always. Thank you, sir. On the risk of a melt-up, a risk that ultimately many of you, I know, want to earn. Economy's resilient, earnings story's been good, and it's the earnings profile of these names that make this moment so different in the minds of so many that come on this programme to what we witnessed back in the late 90s.
That's what Ed keeps going back to. The earnings profile is so strong right now for some of these companies. He's like, why wouldn't you want to be a part of this story? Next year, I think, will be interesting. How high is the bar for some of these companies to clear to make sure that this, what some would call maybe frenzy, Jonathan, just continues?
Trilogy Metals in the pre-market. What a move. Just waking up to another one. We joked about this, scanning individual miners and working out who would be next. Trilogy Metals is next.
Exactly. Who are their peers? because you probably want to take a stake in them ASAP. Wall Street Journal this morning said 5 employees work at this company right here. Obviously, I came in and said that to you, and you said, of course, it's the assets they want to get after. Of course, it's those assets. They want the raw materials, the critical minerals. But we are just, 8-9 months to the Trump administration? How many equity stakes have we already seen? 4 plus the golden share when it comes to Nippon Steel. This is a story that will continue throughout the Trump administration. They don't want to do grants. They want actual stakes, and they know exactly where they're going. They're going to places where they need to have U.S. critical infrastructure in somewhat better form, I guess, to take on China. But for someone like Ed Yardeni, it makes him nervous because it's not free market capitalism.
It's 4 and counting. That stock is up by close to 170%. Let's give you an update on stories worldwide this morning. Let's get over to your Bloomberg brief, this time with Lizzie Burden. Hey, Lizzie.
Hey, John. Representatives for Israel and Hamas have begun discussions over a deal that would free all remaining Israeli hostages in exchange for thousands of Palestinian prisoners. US President Donald Trump is pressing both Israel and Hamas to secure an agreement as the war hits the 2-year mark since it began. The talks are set to continue for a second day in Egypt. Elsewhere, French President Emmanuel Macron gave outgoing Prime Minister Sébastien Lecornu 48 hours to negotiate with the country's political parties to prevent the country from falling deeper into crisis. Lecornu's task is to define a platform for action and stability for the country by Wednesday evening, after which Macron will decide his next steps. And Tesla plans to unveil a cheaper version of the Model Y today to counter the loss of US incentives for electric vehicles. The cheaper vehicle will lack certain features and use less premium materials. Executives said production of a more affordable model started in June, but they decided to put off ramping up output until after the US phased out tax credits. And that should be my brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Big move in that stock. Tesla performing quite nicely over the last month or so, since early September, up around 30%. We'll have more on that story later this morning. Up next on the programme, contradictions in Washington.
We have a negotiation going on right now with the Democrats that could lead to very good things.
I think both House and Senate Democrats are clear. We'll sit down anytime, any place.
We're talking to them. I mean, I'm not saying that's going to happen.
That conversation up next with Gardner of Stifel, live from New York City this morning. Good morning. Some programming notes for you. Later on this morning, Bramo sitting down at 7:30 Eastern Time with the ARES co-president, Kipp deVeer. Look out for that. And later, look out for this. Jamie Dimon, JP Morgan Chase chairman, CEO, sitting down with Tom McKenzie over in London, 11:40 Eastern Time. Look out for that conversation later on this morning. Before all of that, let's check out the price action. Equity futures on the S&P 500 are raising this morning's losses. The S&P on a 7-day winning run. The S&P 500 at all-time highs. The Nasdaq at a record. The Russell at a record. In the bond market, 2-year, 10-year and 30-year bond yields. 10-year bond yields higher by a single basis point. Let's call it 417 on 30s, 476. A sigh of relief over in Japan. Decent auction at the long end a little bit earlier on this morning, removing some of the fears about government debt. That's been the main focus as we kick off this trading week. France, Japan, the lack of a government in one place, a new government in another.
Well, I have to say, France, I find just absolutely unbelievable. You have the front page of some of the newspapers having the Elysee Palace. According to Caroline Conan, says, is anyone there? What is Emmanuel Macron going to do? This prime minister has been in power for 27 days and he's failed. Yet, Emmanuel Macron refuses to step down. He's going to what? Appoint another prime minister that, guess what, is not going to be able to get a budget through. And this is going to be a deepening cycle till something really just busts.
This is one way of getting some euro weakness. Euro weakness again this morning, down by about 1/3%. Euro dollar 116.71. And as events this morning, let's bring it back stateside. Contradictions in Washington.
We have a negotiation going on right now with the Democrats that could lead to very good things.
It's an interesting statement that the president has made, and I think both House and Senate Democrats are clear. We'll sit down anytime, any place.
We can have a much better health care than we have right now, and we're talking to them. I mean, I'm not saying that's going to happen.
So here's the latest this morning. President Donald Trump saying he would negotiate on health care as the government shutdown drags on. The president later adding he would only be willing to talk after the government reopens. Bloomberg's Tyler Kendall joins us now with the latest. Good morning, Tyler.
Hey, John, good morning. Some perhaps mixed messaging from President Trump, but the fact that he's indicated that he's open to talks in at least some regard is seen as a positive step and would mark a shift for Republicans, which have really been holding the line that the government needs to reopen before negotiations can begin. With that said, we haven't seen any real indications that lawmakers are moving in the right direction. Take last night, for example, when the Senate voted and rejected for a fifth time the House passed stopgap measure that would fund the government until mid-November. Now, one of the central questions that's emerging here is whether or not Democrats would get on board with a commitment for what's known as an up and down vote on extending those expiring Obamacare premium tax subsidies, because ultimately that wouldn't mean that the extension would pass, but it would mean that it would at least get to the floor and there could be a conversation about it out in public. But whether or not that's actually something that could come to fruition really does remain to be seen, because Republicans are split on these subsidies, many of which go to people in states President Trump won in 2024. These are Republican-led states that chose not to expand Medicaid and therefore have more people on Obamacare insurance exchanges. With that said, many of these Republicans want to see structural changes when it comes to the program, such as income caps, and they argue that this is a conversation that is going to take time to hammer out, and it's not going to happen in a matter of days. And John, in a matter of days, we're going to see a few more pressure points emerge. Of course, we're watching closely the threat of permanent layoffs, but I'll also add to your radar that this Friday, October 10th, federal workers will miss their first paycheck. And then also watch out for developments around the WIC program. This is a key federal nutrition program that goes to women and children. It's expected to run out of funding this week. And when that happens, I'd expect those alarm bells to start going off.
Tyler Kendall with the latest in Washington. Tyler, thank you. She talked about pressure points, Annmarie, and typically this is how it goes. You've been talking about it now for the last week or so. You hit those inevitable pressure points and this thing ends and we move on. That's what Wall Street is used to. That's what Washington has conditioned us to get used to. Is it different in any way, shape or form this time around?
Well, we need to see what happens after Friday, October 10th, when federal workers should get paid. I still am looking at the Virginia and Maryland senators. Is that going to be a pressure point for them? A lot of constituents that work in the federal government live there. And then October 15th, that is when our servicemen and women are going to get paid, or supposed to get paid. That is going to be a huge pressure point for everyone in Washington, D.C.
To build on this conversation, Brian Gardner of Stifel joins us now for more. Brian, welcome to the programme, sir. Typically, as we've discussed, you hit those inevitable pressure points and this thing ends. Do the usual rules apply?
I don't think their usual rules apply to anything anymore, Jonathan. I mean, you know, I was listening to your conversation. I'm just thinking back to Rocky III and Mr. T, the character, his prediction for the outcome of the fight, pain. And that's what we're going to get to. But do the pain points really play in like we have expected them to do so in the past? I think it's an open question. I really had thought that we would be closer to a deal by now, and that is not proving to be true. So far, it looks like lawmakers are protected from that pain. We'll see how those new touch points play out over the next couple of days.
Do you think we get a deal between Democrats and Republicans, or do you think the pressure points could build for some Democrats to then vote for the clean stopgap funding measure?
Yeah, I think the best way to think about it is we could have a comprehensive deal. I would not rule that out. I think the more likely outcome is an agreement to agree later, a deal to get to a deal. Not a full deal on the Obamacare subsidies, because I do think there's some complicated discussions that still need to take place. There needs to be some hand-holding with the rank and file, because you do have Republicans like Marjorie Taylor Greene, who came out overnight, full-throated support for extending in some way, shape, or form the subsidies. But you also have some conservative Republicans who don't want them extended. So I think the politics of this issue are complicated, and so getting to a deal is complicated. So an agreement to agree later a deal to get to a deal is probably the most likely outcome.
Is that going to be good enough for Senate Majority Leader Chuck Schumer, who's under a tremendous amount of pressure from his own flank?
I think, Annmarie, I think we need to separate Schumer from the rest of the outcome. Schumer has his own personal politics that he needs to attend to in New York, his standing as leader. I think what a good leader does when they know that they are in a tough position. They may not agree to the final negotiated settlement, but at the end of the day, he can let his members also pursue their political interests. So we probably will see a deal or a vote where Schumer does not back it, but at the end of the day, more than 8 Senate Democrats do, because it's in their political interest. And since it's in their political interest, at the end of the day, it's ultimately in Chuck Schumer's political interest as well.
Brian, as you know, the government shut down, but the asset management wing of the White House is still operational. Trilogy Metals, this move in the pre-market, up by 172%. This is a company, as you know, that has mining claims in remote areas of Alaska. These are some of the critical metals, the materials that we need to really succeed here in the United States. And Brian, it's another stake taken by this government. Brian, can we just start with the basics here? When we see news like this, where is the money coming from to do this?
It's deficit finance. I mean, this is the same financing that the administration has been rolling out in aid to farmers, tariff rebate checks. It's still deficit financing at the end of the day. So it's a potential problem longer term for the bond market, which doesn't seem to care right now on the bond vigilance. You had Ed on a little while ago. We have yet to see the bond vigilantes perk up and make a statement. But at the end of the day, like I said, it is deficit financing. And I agree with that. It's state capitalism. I would take it a little bit further. It could be beyond state capitalism into a more robust form of socialism, because it is controlling the means of production. So it's a slippery slope. I understand the rationalization of why the White House wants to do it, and the rationalization that it's in the national interest for national security, but it is a very slippery slope once you head down this path.
Brian, should we expect more from the Republican Party when it comes to these type of deals?
Absolutely. I think they've been very clear in signaling this. I put a note out after the NVIDIA announcement, the Intel announcement a couple of months ago, because at that time, the president announced that there would be more deals like this, said it's a no-brainer to do these, that it's in the interest of Americans. Again, I'm not going to take issue whether it is or isn't, but it's worth noting that at the end of the day, it is a slippery slope. Once you start down the path of owning private corporations, even if it's a non-voting share, the government is going to exert incredible pressure and give benefits and advantages to that firm over its competitors. And that stops being capitalism as we have traditionally known it, is really more of a form of state capitalism.
Brian, appreciate your time. Brian Gardner there of Stifel. It's a change, a new kind of statecraft in Washington, D.C., and it's coming together in real time. This is MP Materials. This is Lithium Americas. It's Trilogy Metals this morning. It was Intel previously. That was a major stake in terms of the money used compared to these kind of investments. But we're going to see more of this based on the communication coming from the White House.
And the golden share of U.S. Steel. So we have seen this administration not want to do grants or loans. They want to go for outright stakes. It is unnerving some people I talk to, even if they don't say it out loud, because everyone you talk to says this is state capitalism. Brian went as so far as to say this is socialism. And yet this is going to be the rules of the road of the Trump administration. If they think there's a national security risk and they think this is how they can compete with China, they're going to do it.
This is a White House of entrepreneurs, risk takers. You are an entrepreneur when you are a private individual making these investments. It is something else when you're sitting in the White House doing the same thing.
Absolutely. But Trump, not sure he understands that fully, and he wants to use the weight and power of the U.S. government for this. Also, this company is based in Canada, and he'll be meeting with Mark Carney today, so I'm sure we're going to hear more about this.
Watch this space. Later on today, that stock is higher by 171%. Up next, we'll catch up with Kipp Juckes of SocGen as French political turmoil weighs on global markets. Seven-day winning run on the S&P 500, all-time highs on the benchmark stateside. Not just the S&P, also the Nasdaq. and the Russell. Futures this morning just about unchanged. Another AI-focused deal boosting sentiment in the last 24 hours, driving this equity market. Driving the bond market in the last 24 hours, developments in Japan and France have been absolutely dominant. Yields have been rising, led by the long end of the curve. You see a bit more of that today. Let's call it higher by a basis point on 10s, likewise on 30s. The story, we just turned down the volume just a little bit. If you look at the latest news out of Japan, a firmer bond auction helping things out so far this morning. Stateside, we'll have our own auctions tomorrow, $39 billion of 10-year notes, and then after that, the following day on Thursday, $22 billion of 30-year bonds. That's the situation in fixed income. Let's get you an update on some single names, your morning movers with Yahira. Hey, Yahira.
Hi, John. AMD is extending its monster rally up another nearly 4% in the pre-market after news yesterday that OpenAI was going to purchase up to 6 gigawatts of AMD chips. On the back of that, a number of analysts raised their price target, but Jefferies is notable because it also upgraded the stock to a buy, saying that this is a strong validation of AMD's AI roadmap, something that they had not seen before. They also raised their price target to $300, which is now the street high. And moving on to another company that you guys have been talking about all morning, and that is Trilogy Metals, soaring 170% on news that the U.S. is taking a 10% stake in the company, part of a $35 million push to unlock critical energy and mining projects in Alaska. It's the latest move by the Trump administration, taking direct equity stakes in these companies to combat China. But not everyone is getting a slice of the action, and that brings me to my next stock, which is Critical Metals, down about 1% in the pre-market, as the White House says that it is not considering a stake in this company. But reports yesterday of a possible deal had sent it soaring 45%. John?
Yahira, thank you. More from Yahira later in the programme. On our radar this morning, France's political chaos deepening. President Macron giving his outgoing Prime Minister Sébastien Lecornu a 48-hour deadline to negotiate a stable government. Elsewhere, AMD shares still rising after landing a blockbuster deal to build AI infrastructure for OpenAI. CEO Lisa Su calling it a massive opportunity.
I have full confidence in, OpenAI, Sam, Greg, Sarah. I mean, this is a massive opportunity for us. Right now, right here, it's about who has the most compute and how fast can we get it online. And we're committing to doing this together.
That story driving that stock a whole lot higher. And elsewhere, gold continuing to hover near record highs. Citadel CEO Ken Griffin calling the rally, quote, really concerning.
As you see sovereigns around the world, as you see central banks around the world, as you see individual investors around the world go, you know what? I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me.
That story has been driving gold closer and closer to 4K.
Yeah, it's up, around 50% this year alone. If you are a central bank or an individual investor, you're concerned about potentially what is going on, reordering of the geopolitical order around the world by this administration. You don't really want to put your money into dollars. You want to hedge a little bit. You're not going all in on treasuries. What are you going to do? You're going to go to gold. I thought this was fascinating. 11th straight month when it came to September, you see China's central bank just buying up more and more and adding to their gold asset.
It's not just about the US. Ken Griffin's there talking almost exclusively about the United States. It's also more broadly, and Lisa was talking about this yesterday, a failure of some of these governments to be good stewards of capital. That's what Lisa said just yesterday regarding gold. And I think this story also really started in Europe. I think we have to point this out. This wasn't a US catalyst. This was a European catalyst. The moment they started discussing confiscating Russian assets, that was extra fuel for this move.
Absolutely. That's when you started seeing a lot of these central banks really start to buy gold and not want to put all their money into dollars and diversify away. That was one of the biggest things the Biden administration did alongside what happened in Brussels, is to freeze Russia's central bank assets, basically all the dollars that they've been building up. They cannot touch. So what are you going to do? You're going to look elsewhere. But you don't really trust anything because who's to say no one else can freeze those sovereign assets? So you're going to buy gold.
Gold down about 0.1% so far this morning. Speaking of Europe, let's turn to France. The president, Emmanuel Macron, giving his outgoing prime minister 48 hours to negotiate with France's political parties and define a platform for action and stability for the country. Bloomberg's Caroline Conan is tracking the story in Paris and joins us now for more. Good morning, Caroline. What can we expect over the next 48 hours?
We've already seen a lot of twists over the past 24 hours before the grand finale on Wednesday night. This is a deadline that President Macron has given outgoing Prime Minister Sébastien Lecornu, who resigned yesterday after not really being able to compromise within his own government that lasted 14 hours. Now, the negotiations are continuing. This morning, Lecornu met with his own camp. Next 24 hours, he's going to meet with opposition parties. But the least we can say that President Macron is really back against the wall. This is actually the front page of this Figaro newspaper this morning, and more people, including within his own camp, are calling not only for snap legislative elections, but also for early presidential elections. Edouard Philippe, former prime minister within Macron's first government back in 2017, saying that perhaps one solution would be to have some sort of caretaker prime minister in order to pass a budget before the end of the year, and then Macron would leave with honor if he called early presidential elections. Yesterday we saw President Macron walking alone along the Seine, this picture of him being more and more isolated. 70% of the French, according to the latest poll, actually want his departure and want early presidential elections. Is this what we're going to see over the next 24 hours? Nothing is out of the table. See this other front page with the Élysée Palace, Macron's residence, saying, is there anyone there?
The pressure keeps building. Caroline, thank you. Caroline Conan tracking the story out of Paris, France. We're tracking the story across the market as well. French bond yield still bleeding higher. The euro a bit weaker as well. Euro dollar 116.73 so far this morning. To build on this story, Kit Juckes of SocGen joins us now for more. Kit, is this France's problem, and welcome to the programme, or is it Europe's problem?
It could become Europe's problem. I mean, at the moment, Mario Draghi's whatever it takes commitment all those years ago is doing an awful lot of work in terms of preventing this, weaken the currency much more or widen yield differentials much more. And so that side of it's all kind of holding together. But, that you need to create stability in each country rather than just rely on this overall commitment. So I think the market is doing a good job of not getting too worried about it. There is need for a political progress, actually right the way across Europe. We need governments that can govern, we need growth that can grow, and so on.
Do we need additional pain for that to happen, Kit? If we carry on with this and this muddle through, I don't see the incentive for the French government to get its act together. I've been saying this for a while now, and I wonder if you agree. There needs to be more pain doing nothing than doing something. And right now there isn't, because the market hasn't been unleashed. Because, as you mentioned, the ECB and OMT of the Draghi years, TPI of the Lagarde years, Kit. I just wonder if we need that market pain to provide the solution.
It's certainly hard at the moment to see. You would hope that politics would deliver solutions because, this is the next generation's future that we're messing around with right the way across Europe here. So, but I wouldn't disagree. This has been going on for a long time. You can see I sit there looking at markets and, the fact that the euro is not tumbling against the pound or even the Swiss franc, more particularly, does give you an indication that the pressure is not going to be created by the market yet. And if that doesn't mean that there's a sense of urgency, then I don't know what happens. I hope the French press, with the kind of headlines they're now throwing out, gets the message across to the government that you need to get on with governing, because otherwise we're just going to stay and wallow around here and things are going to get worse.
Kit, you're talking about these European governments that can't govern, yet Christine Lagarde this week saying there's a unique opportunity to create conditions to strengthen the euro's role on the global stage. How can the euro be strengthened on the global stage if the European governments basically don't even have government?
I mean, you can do some things to strengthen it. There's lots of good things you could do with the euro to make it work more smoothly and to act as one unit and to turn Europe into one solid economic area with fewer boundaries than exists now. But I don't disagree that if you want a strong euro, you need to be able to build the foundations of strong growth, of stability, of organization on all sorts of levels. And if we can't get past the fact that we've spent decades now undergrowing, being shown up by the United States in particular in terms of what you can do in terms of generating, a more prosperous society, then in the end, I will continue to do what I do, which is watch the days when I see euro-dollar trading at 160, 150, 140, 130. I'm never going to see them again.
U.S. protectionism, tariffs, could this help a global euro moment, or actually could it hurt them?
It could be a catalyst for helping a global euro, but it's not an ideal catalyst. I would rather we had positive things making the euro more used, more useful, the European economy more dynamic, more likely to attract inward investment to propel growth rates faster here in Europe. Those would be good things. Turning around and saying that people aren't sure about holding a lot of dollars because of the uncertainties about the U.S. administration, that's not the ideal basis for a strong anything else.
And not particularly interested in holding euros either, Kit, and that's the point, isn't it? They're holding gold, increasingly looking for a move elsewhere. Out of all the currencies, Kit, and you've been doing this a long, long time, is there a currency that you have confidence in?
Confidence? I have confidence in the Australian dollar. They apart from anything else, I saw on the terminal this morning that the value of their gold exports is going to accelerate past their liquid natural gas exports. There's a country that's got something going for it in this world. I have confidence in the Swiss franc. They won't let it go up, and they'll accumulate assets abroad to prevent it, but I have confidence that they can run it. But no, I have confidence in the dollar, in fact. What I don't have confidence is buying the dollar when it's this expensive, and that's a different question.
Kit, before you go, I want to finish on the latest out of Japan. Of course, we've covered a lack of government over in France, an inability to govern, seemingly. We've got new leadership in Japan. When we had that moment with Abe, it was a huge directional trade that started to build in the Japanese yen very, very quickly. Do you see it the same way this time? Back in 2013, it was one thing. What is it in 2025, 2026? Is it more constrained this time around?
I don't think it makes sense. When dollar yen was at 80 and Japan was stuck in deflation with a massively overvalued currency, getting the currency to weaken was something that could help the economy, that potentially could have done a lot more. Weakening your currency when all you're going to do is push up import prices, make tourism more attractive to come in from abroad when already you've got as much of it as you can cope with, looks to me like a bad policy. The policies they need to come up with in Japan are policies on making the economy more competitive domestically and getting it moving and just putting more, competitive juice into the system. Trying to go with devaluation as a policy from here, I think is a really bad idea.
Of course, back then we were looking for dollar yen to break 100 again, and this morning we're already at 150. Kit, it's good to see you, sir.
Exactly.
Kit Juckes, SocGen with the latest. Dollar yen at 150.74. That currency pair, again, up by about 0.25%. That's a weaker Japanese yen. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. The US government shutdown has entered its 7th day after the Senate's 5th vote on a stopgap spending bill failed. President Donald Trump is now expressing a willingness to negotiate with Democrats. The president taking to Truist Social to share he's happy to work with the Democrats on their failed healthcare policies or anything else. But first, they must allow our government to reopen. Elsewhere, shares of mobile advertising company AppLovin are lower as the SEC begins a probe into the company over targeted ads. Sources telling us here at Bloomberg that the company violated agreements to collect data for the ads, claims that were escalated by a whistleblower, and reports of short-selling the stock. AppLovin denies the claims it tracks users across websites and apps to target them with ads. And the International Energy Agency slashed its forecast of US renewable energy growth by 2030 in half. The reduction compared to last year's analysis is due to several policy changes imposed under President Donald Trump, the IEA said. Global renewable power is expected to increase by 4,600 gigawatts by the end of the decade, according to this report. And that's your Bloomberg Brief. John.
Lizzie, thank you. Appreciate it. More from Lizzie in about 30 minutes from now. Up next on the programme, the AI boom.
The reality is the AI boom is real. Lots of opportunity for productivity gains and ultimately maybe a surprise to the upside in growth over the next several years.
That conversation up next with Neil Dutta over NMAC, live from New York City. You're watching Bloomberg TV. Government shutdown continues. This is day 7.
Day 7.
This is day 7. That continues, which means we're light on economic data once again this week, potentially, which means additional importance for the earnings. Delta Airlines reporting on Thursday. Look out for that. The government still needs to finance itself, so look out for a 10-year debt auction coming up on Wednesday too. We'll get $39 billion of 10-year notes coming to market, in addition to the $22 billion of 30-year bonds that come the day after. Fed minutes in focus. Look out for the division at the Federal Reserve. But ultimately, for a lot of equity market bulls, it's not about Fed policy. It's all about what's happening with AI. Your equity market shaping up as follows on the S&P 500. 7 days of gains on the S&P, just about unchanged this morning. We've seen it across the board in conversations right here on Bloomberg. UBS, evidence of possible melt up into year end. Evercore, increased probability of a bubble. Evercore last week as well, Krishna Gua. This is an incredibly risk-friendly moment. And based on a price action of the last 6 months, I think a lot of you invested in this market agree. Under surveillance this morning, the AI boom.
The reality is the AI boom is real. It's not going to be a question around hundreds of billions of dollars of capex, but rather trillions. It's really going to impact and benefit multiple sectors of the U.S. and the global economy. Not just technology, lots of opportunity for productivity gains and ultimately maybe a surprise to the upside in growth over the next several years.
It's the latest this morning. AI enthusiasm lifting markets to record highs and driving hopes of a boom in productivity for the labour market. Neil Dutta of Renmac is unconvinced, writing, folks are conflating a productivity boom with a disconnect in the data. AI adoption is increasing, but historically productivity does not increase alongside adoption. Neil joins us now for more. Neil, welcome to the programme, sir. Just that last line, can you just explain that a little bit more? What do you mean by that?
Well, sure. I mean, if you think about, and good morning, John. If you think about, just a business, like let's say we're trying to integrate AI into our workflow, that is a time-consuming and arduous process that actually takes away from productivity in the interim. I can experience that in my own firm, right? So that's the so-called productivity paradox, right? Just because it's all everywhere around you doesn't mean that it's in the productivity statistic necessarily. So I think what people are talking about in the third quarter has really nothing to do about AI, and it doesn't, in my opinion, represent the front edge of some kind of productivity wave. It usually takes a number of years before people and businesses understand the technology, integrate the technology into their work processes, and then gain the maximum productivity out of that new technology. So it's probably, think about the desktop computer, right? I mean, that made its way into corporate America probably sometime in the early 1990s, and it really wasn't until the mid to late 1990s that productivity began to take off.
So do you think potentially we're in a bubble when it comes to what's going on in the stock market?
I don't say bubble. I never say bubble. I mean, I think
okay, what do you say? What would you call it?
I mean, I think that there's a lot of enthusiasm. People feel, I mean, there's certainly a bit of a chase, right, where people feel like they need to, buy into the technology. There is some of that. But, the market seems to be, I mean, this sort of new economy dynamics, right, at least for AI. So is that necessarily wrong? I'm not sure. But, I go back to the kind of framing that I used earlier. Like you have this sort of three economies bucketed, right? One, the housing market's in recession. One, the consumer is, sort of in the middle, and then you have this other piece, the AI, that's booming, and you certainly have an element of people feeling that they need to be invested in it, but it's also, investors betting on a new economy type dynamic, and all the sort of potential profits that go with it. So, who am I to call that a bubble?
Ed Yardeni was on earlier in the program. He's very excited about what's going on. He's definitely bullish. And he also thinks real wages will rise. Why do you think he's wrong?
Well, real wages aren't going up. They're actually basically flat over the last few months and, barely growing at 1% over the last year, which is, hardly consistent with the sort of productivity boom that people are talking about. At the moment right now, the AI story is, unlike the 90s, I mean, it's creating a bit of fear in the, among households, right? Because the employment loss is substantial, and people, or the threat. I mean, I don't think anything going on with employment right now has to do with AI, but people are worried about that threat. But if you look at it, I mean, There's a bit of a crowding out going on, no? I mean, you have utility costs going up because of the data center build out. You don't really have much employment growth going on. So why would anybody expect real wages to grow, at least for the near term? You still have this ongoing slowdown in the labor market to contend with. So I'm just looking at the data. You haven't seen real wages go up. You may, but you still have to contend with this ongoing slowdown in the labor market that I just mentioned.
Neil, let's just stay on the data. You mentioned electricity prices, the tension that could be building on the FOMC. Do you think that dual mandate is going to come into conflict even more in the months to come?
No, because I think it's going to be increasingly obvious that the unemployment situation is getting worse and the Fed will have no choice but to continue to recalibrate policy.
What makes that obvious right now, Neil, to you?
Well, number one, consumers continue to paint a picture of an ongoing slowing in the labor markets. Consumers tend to spot changes in their local economies before the official statistics. So if consumers tell you things are getting worse, I think it pays to believe them. Second, there's probably increasing downside risk to residential construction employment. We know that building permits are at cycle lows. So builders who've hit their pivot point on margins probably need to take steps to deal with those margins. And that probably means that residential construction employment, which is bloated, starts to come under pressure. And I think that'll probably affect the broader labor market in ways we don't yet understand. So, no, I don't think the goals are going to become more intense. I think it's going to be very obvious in 6 months what will need to be done. And because labor markets will get worse, inflation will take an even bigger a deeper backseat than it has right now.
To the extent that the Fed can agree on anything right now, they agree that this is the risk management phase. Neil, what's the next phase then? If we move beyond risk management and we ultimately have to confront the risk, we've got a Governor Myron dot that is way south, way below everyone else's. And I've heard a lot of people throw some shade at that dot over the past month. Do you think that's a dot perhaps we should take more seriously?
I mean, I think it's really about the speed at which you get to his dot, right? I mean, I don't think you necessarily should take it seriously for this year, but maybe you take it a little bit more seriously next year, right? And certainly the risk is if the slower the Fed goes up front, the bigger the risk is that they have to do a little bit more later. So, I don't agree with him that, longer run neutral rates are as low as he says they are, but directionally, I mean, come on, like it's obvious that neutral rates are lower than where the Fed thinks, maybe by a little bit. So it's really about the magnitude that we're disagreeing about, not necessarily the direction.
Neil, appreciate your time, as always. Good to see you. Neil Dutta there of Renmac on the latest on the economy. Without the data right now, but ultimately some conviction from Neil. And this has been building a long, long time for Neil Dutta of Renmac. Coming into 25, he was worried about the slowdown. And as far as he's concerned and others, that labour market has continued to slow down.
Absolutely. He's been talking about this even last year. I'm glad you asked about Governor Myron because he took some heat recently from former Treasury Secretary Larry Summers. And Neil came to bat for him, saying Steve Myron should stay on the Fed after January campaign was just made a massive contribution from one Larry Summers.
Yeah, the groupthink of the Fed's been a problem for a while.
Yeah.
And the Summers of these worlds has contributed to that groupthink, let's put it that way.
Yeah, and next year, I think this is indicative of some of the dialogue.
It's some new voices, don't we? These establishment figures from the 90s weighing in on things all the time. We need some new voices, some fresh voices in economics. Coming up next, Dan Skelly of Morgan Stanley, Libby Cantrill of Pimco, Kipp deVeer of Aris Management, and the Connecticut Governor, Ned Lamont.
You have a global phenomenon of pretty challenging fiscal situations.
We have to keep our eyes on the economic reality of the global economy.
The bigger macro picture is getting more confused.
There is already a giant question mark around what data should we be using. Growth has been pretty solid, and actually there's scope for it to reaccelerate in 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs on the S&P 500. 7-day winning streak, the longest daily winning run going back to May of this year. Let's see if we can make it day 8 on the S&P. On the Nasdaq 100, just about unchanged this morning. Likewise on the Russell, small caps also at a record. In the bond market, yields have been bleeding higher over the last 24 hours, led by developments in France and Japan. It continues this morning, up by a basis point or two on 10s and 30s, going into an auction tomorrow for 10-year government bonds. and the day after we'll get 30s. The main event this morning in the pre-market, just this monster move we're seeing in a very small name, but an important one. Trilogy Metals up by more than 200% in the pre-market as the government takes a stake.
Knock, knock, knock. U.S. government on the door looking to take a 10% stake in yet another company. Obviously, it's very clear what this administration is going after companies where they can get access to these critical raw materials in a way to compete with China. The way they're doing it has some people unnerved, whether they want to say it out loud or not, especially Republicans in Washington, D.C. You could say this is national security, or you could say this is state capitalism. And there have been a number of instances already we've seen from this administration, and Trilogy is just the latest.
When you make deals as a private investor, you are described as being an entrepreneur, a deal maker. When you make those same deals when you're a government official, you will be accused of conducting central planning. And that's the criticism that will come with these kind of deals.
Absolutely. And the question mark is, besides this competition with China and getting access on these rare materials, whether you need it for supply chain, steel build out, the AI data centers, and everything the stock market is pinning their hopes and dreams on, is this question of what happens in 4 years' time, 8 years' time? And is there really going to be competition in this space if the U.S. government continues to just make all of these acquisitions in it? And does it mean that, are we going to get a sovereign wealth fund or not? And is it really fair that the administration is not being upfront with what they actually are doing? Are they going to make a sovereign wealth fund? Because they're not being explicit about it.
What a move on that stock, up 220%.
5 employees.
Wowza. In a pre-market right now. We'll stay on top of that for you. Coming up this hour, Dan Skelly of Morgan Stanley with Wall Street hitting new highs. Libby Cantrill of Pimco as the US makes a push to win the AI arms race. And Kipp deVeer of Aras with massive investments feeding the tech boom. We begin this hour with stocks hovering near record highs. Dan Skelly of Morgan Stanley saying tech bubble talk may be misplaced. He writes the following: when abandoning basic investing principles of diversification and risk management is never a good idea, the market's longer-term tailwinds remain intact. Dan joins us now for more. Dan, good morning. Good to see you.
Great to see you, John.
What are those longer-term tailwinds? What are they?
We're definitely seeing momentum in the economy. So the services sectors continue to hum along really strongly. The high-end consumer continues to push forward as well. And then, of course, the AI economy, right? We estimate that AI spending equated to about 100 basis points of second quarter GDP. So call it over a quarter of the economic growth is coming from this AI supercycle.
Is it just a handful of companies, or is it more than that? Because at the moment, for some people at least, the criticism I've heard from analysts that have come on this program too is that this is very circular. It's the same money just changing hands and going round and round. Is it more than that?
There's part of that, no doubt. I mean, you're starting to see leverage starting to be used as well to fund some of the investments. Prior to that, it had been strictly cash flow. So that's something we're keeping an eye on, John. But we're definitely seeing no end in sight in terms of the spending increases going into next year.
When John says circular, in my mind, I'm thinking of what's going on with OpenAI and NVIDIA and now AMD. But is it also circular to the point of the U.S. government, given the fact that they're taking stakes in a number of companies? And you talked about how AI spend is basically 100 basis points of GDP.
Yeah, and so it's an excellent question, Annmarie, and I guess the way to look at it, it's also the absence of a negative. Do you want the government to over-regulate things as well? And I think for prior years, prior administrations, we heard a lot about regulation across not just tech, but energy, financials, et cetera. And so, it's a question of which path do you take? And I think in many ways, looking at all the leadership and management teams of the leading tech companies partnering with the administration, it's probably not a bad thing.
If you want to have a hedge, and maybe you're just kind of getting over the gold rally and you had enough, what are you looking at?
Excellent. Another excellent question. So the one thing gold does not provide is income. And when you look at factors year to date in the equity market, it's been a momentum market. In many ways, it's been a beta and realized vol market, so a little bit lower quality. So what we're advising clients right now, particularly on the individual investor side, is look at some dividend yield and dividend growers. They've been out of favor, but if we get a little bit of a consolidation in the near term, they should be a decent hedge.
Let's stay on track of that. Let's just stay on that theme. What's the relationship at the moment between government bond yields and what's happening with gold? Because yesterday was an interesting moment. We had developments in France and Japan pushing government bond yields higher globally. And at the same time, the rally in gold continued because of the concerns of the governance issues in those countries. What's the traditional relationship and what is it now?
Yeah, typically rising rates should have been, I think, pretty solid for gold, should have been a positive correlation. I think in many ways, though, John, gold is taking on a lot new attributes, and there's other inputs going into that calculation. Let's keep in mind that certain members of the Treasury Department and certain members of the private sector who went to Washington, famous robotics and car makers, were supposed to be fiscal hawks. And you've seen quite the opposite. Right, so there's this other big driver going on in terms of the deficit widening still on the back of the tax deal, and this is bullish for gold.
These are some things that typically central banks might want to slow down. It feels like it's very different this time. Mary Daly, the San Francisco Fed president, talking to Axios today, saying that ultimately the stock market would not threaten broader financial stability and that the AI bubble isn't a financial stability threat, even if there was one. Do you share that sentiment at the moment?
We don't see AI as a bubble, and frankly, one of the reasons for which is the earnings power of the leading companies continues to increase. So the Mag 7, as an important example, wears this interesting duality hat. It's the biggest spenders, but also at the moment, the biggest initial beneficiaries. Mag 7 earnings growth year over year in the second quarter was up 28%. Rest of market was up only 4%. We think that nominal GDP did about 7% in the second quarter. So what that means is a lot of other companies are either taking it on the chin from tariffs and profitability hit, or they're just not monetizing AI enough as they adopt. And so at the moment, the earnings power is so strong still in Mag 7 in the leading AI companies that we don't see a bubble.
You like the banks. That's one of your top sector picks. Why is that?
We do. So we've liked the banks for well over a year, and that's been a winning theme for a while. But first off, we still think there's tariff P&L risk on the horizon for lower quality businesses that have supply chain risk. As a domestic industry, banks don't share that risk. Number two, capital markets have been recovering really strongly in the last 3 to 6 months. And lastly, I would just say deregulation, right? This is a sector that had been, per my comment earlier, pretty onerously regulated for 10 plus years, and we're seeing those fetters come off.
A lot of people like the banks now because of the Trump administration. Do you expect more consolidation as well when it comes to financials?
No doubt, Annmarie. So when you look at the history, anytime you go through big structural shifts, whether it be 1980 savings and loan, whether it be 2000, the tech crash. So we've just continued to see this narrowing of the regional bank sphere in particular. We had something like 8,500 banks going back 30 or 40 years ago. Today, that's 4,500 banks. When you look at other developed markets, major developed markets like Canada, as an example, many fewer leading banks there. So we definitely continue to see consolidation in the regional banking sphere.
When investors say they like the deregulation push from the Trump administration, can you pinpoint exactly what that is?
Sure. One of the biggest levers is capital constraints. Right. So I think in the coming months and quarters, you're going to see more and more alleviation around capital. And that's going to flow back into what banks can do on the M&A front, no doubt, returning shareholder capital or just loan growth. I think, ironically, one of the things people have looked at is this winner-take-all AI spending environment and lost sight of the fact that overall loan growth is actually also improving across the rest of the economy.
Dan, just to finish on that.
Sure.
Where this growth has come from and what's funded it, I think is a really important piece of this conversation, particularly with regards to the CapEx spend. Where is the cash coming from? And what's the difference between previous infrastructure cycles of decades gone by, how debt financed it was before, relative to what we're seeing now?
Sure. Not only was there debt and equity issuance in the late 90s, but many of the leading tech spenders themselves did not have as proven business models. So let's just not forget for a minute that Mag 7 is really FANG plus 3. And so this has been a winning cohort for 15 plus years. It's super hard to bet against this group of leading companies because they typically have the capital and the talent and the foresight to just go into whatever the next big theme is, whether it was consumer-related technology in the 2010 period, whether it was certainly cloud 2016 onward, whether it's AI today, it'll be robotics next and quantum in the future.
They're pivoting hard, that's for sure. Dan, it's good to see you. Thanks for dropping by. Thank you, sir. Appreciate it. Dan Skelly there of Morgan Stanley. Equities at the moment recovering on the S&P 500, very close to all-time highs. We are on a 7-day winning run on the benchmark stateside. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. French President Emmanuel Macron gave outgoing Prime Minister Sébastien Lecornu 48 hours to negotiate with the country's political parties to prevent the country from falling deeper into crisis. Lecornu's task is to define a platform for action and stability for the country by Wednesday evening, after which Macron will decide his next steps. Elsewhere, the Trump administration is exploring options to sell some of the federal government's student loan portfolio. Politico reporting that discussions have taken place among senior education and Treasury Department officials to sell parts of its $1.6 trillion debt to the private market. And the air traffic controllers unions reminding workers that failure to show up for the job could lead to termination. The warning coming after Transportation Secretary Sean Duffy pointed out a rise in sick calls since the government shutdown. Air traffic controllers and TSA officers are expected to work until they receive back pay once funding is restored. And that should be my brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, Mind, Baby Mind.
President Trump, when he said drill, baby, drill, he also was mine, baby, mine. And this mine area up there, we got copper, lead, zinc, gold, silver, gallium, germanium. So rich in all of the minerals that we need to win the AI arms race against China.
That conversation up next with Libby Cantrill of Pimco, live from New York City this morning. Good morning. Live from New York City, welcome back to the programme. Equity futures on the S&P 500 doing okay. A couple of things to look out for. Some programming notes. Later on this morning, about 15 minutes from now, Lisa's sitting down with Kipp deVeer, the Aris Management co-president on the AI boom. Look out for that and look out for this. Jamie Dimon, the CEO and chairman of JP Morgan Chase, joining Tom McKenzie over in London, 11:40 Eastern Time. That's a few hours from now. I mentioned the broader market, 7-day winning run on the S&P 500, pulling back just a touch, not even by 0.1%, virtually unchanged. Also on the Nasdaq 100, likewise on the Russell. There's a big mover out there. Let's talk about it. Under surveillance this morning, mine, baby, mine.
President Trump, when he said drill, baby, drill, he also was mine, baby, mine. We've got to get back in the mining business. China controls 85 to 100% of all the mining and refining of the top 20 critical minerals. And in this mine area up there, we got copper, lead, zinc, gold, silver, gallium, germanium. So rich in all of the minerals that we need to win the AI arms race against China.
So here's the latest this morning. The White House taking a 10% stake in Trilogy Metals, securing energy and mining projects in Alaska. With the latest, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. So this company has these mining claims in a remote area of Alaska. And importantly, the deal comes in tangent with President Trump reversing a Biden-era decision which blocked something known as the Ambler Road project. This is a controversial project that would build an access road to this mineral-rich mining district in Alaska. And as part of the deal, the Trump administration is going to invest $35 million for Trilogy to conduct exploration in this area in exchange for a 10% stake in the company. Now, the White House says that this is a bid to try to loosen China's grip on the critical mineral supply chain. And if we look at the data from last year, China was responsible for about 70% of global output when it came to rare earths. But this really does continue a more hands-on approach when it comes to industrial policy. Just look at the deals made so far this year by the Trump administration: a 15% stake in MP Materials, a 10% stake in Intel, a 5% stake in Lithium Americas announced last week, not to mention the so-called golden share when it came to the Nippon acquisition, plus that agreement where NVIDIA and AMD were going to give the U.S. government part of its China chip sales. Now, the White House says the common theme here is that this all has to do with national security interest, even as critics say that this could hurt competition and give an unfair advantage. John, importantly here, Trilogy is a Vancouver-based company. The Canadian Prime Minister, Mark Carney, is set to visit the White House for his second Oval Office meeting today, and no doubt this is going to be on the agenda.
He might have some thoughts about that, I'm sure. Tyler, thank you. Tyler Kendall in Washington, D.C. Here in New York, Libby Cantrill of Pimco. Libby, good morning.
Good morning.
MP Materials, Lithium Americas. Here's another one. Some of these names I've never heard of until this morning. Trilogy Metals up by more than 200%. What is the overall objective here? What are we trying to do?
Well, I think that a couple of things here. One is that this does exemplify that this president really does support industrial policy. He has no problem, obviously, picking winners and losers. That is very much a divergence traditionally from the Republican Party, who have always preferred for the private market to function and to pick winners and losers. I think second is just that this underscores the importance from a national security perspective for the president, right? He is doing all these things in the name of the AI race, in the name of competition with China. And third, I think, just importantly, is that there is a limit to all of this, right? I think that, we find that our clients get confused with these, sums of money being kind of banded around. And Congress usually has to actually allocate the money for these types of investments. They're sort of dipping into other reserves or what have you. But for big, significant investments, you'd have to go to Congress. So these things are sort of nibbling around the edges, right? $35 million. But I do think it obviously underscores that this president's very comfortable with, again, picking winners and losers.
Do you think this is the road to a sovereign wealth fund?
Again, I mean, not to get sort of process oriented here, but you would actually need Congress to really facilitate a sovereign wealth fund, even with tariff revenue, right? I think there's a lot of confusion about this, that even though the tariff revenue is associated with a policy that the president obviously has put forward, how those monies are allocated are in the discretion of Congress. So, if Congress decides with the president that they want to, create a sovereign wealth fund, that might be something. But really, for something to be fulsome, to have it function in the way the sovereign wealth fund does, it would need Congress. Obviously, we're also in a deficit country, so I think just editorializing that may not make the most sense.
Whether it's Trump, whether it's Biden, what are the limits of masking whatever you want to do with national security?
Yeah, I mean, the statute, as you know, is very broad. Obviously, the president has used Section 232 of the 1962 Trade Expansion Act for many of his tariffs. That is in sort of this realm of national security. I think you could, quibble around, maybe the national security importance of, let's say, lumber. So some of these things that he's putting tariffs on are trucks. He's using this statute. But the courts historically have given the president wide discretion. So I do think that we will continue to see him using at least the pretense of national security. Whether some of that gets litigated, I think it's, open question.
I'm uncomfortable with central planning. I'm sympathetic with the objectives, but uncomfortable with central planning. I also think you have to be careful what you normalize when you're in power, for when you're not. What happens if someone else is in control of the dials and they have other ideas about what to invest and what to take stakes in?
This is what a lot of conservatives who are a little bit more traditional, I would say Romney Republicans, are concerned about. What happens 2028, for 8 years' time, when you have maybe a Democrat in power that actually likes this idea. Brian Gardner on this program today, when we were debating, is this state capitalism, national security, he said, let's come out and call what it is. It's socialism.
The Trilogy metals up by more than 200%. We joked earlier this morning that the asset management wing of the White House is open. The government is shut down. Let's talk about the government shutdown. A question we've posed continuously over the past week is whether this is different, whether the normal rules apply, whether you hit the inevitable pressure points and ultimately we just reopen. Is it different this time?
Well, it does feel different in that people feel very comfortable with their own political positions right now. So Republicans seem very comfortable sort of digging in, and they're claiming that they've already done their work, right? That the House has passed the sort of straight line funding bill, gets them to November, some time to work out the appropriations bills. On the other hand, Democrats who've historically supported those sort of straight line funding bills are claiming that, this, in addition to funding the government, they need to obviously address ACA subsidies and some other things. So I think that is the thing that feels different about this, is there's not really kind of hair on fire, get all the members back and work to get a resolution. Obviously, the House is not back in session. They may not be back for the foreseeable future. We'll see about what Speaker Johnson does next week. So there seems to be a calm and a comfort that I don't think has really existed in the previous shutdowns. Sadly, I've done this enough, so I've seen enough shutdowns. And usually there is more of a kind of an alarmist sort of flavor, more of a sense of urgency.
Does the alarmist flavor come when people don't get paid?
I do think, so October 15th, that's an inflection point that we pegged for our clients. That's obviously when whole swaths of the government won't get paid, but particularly, active duty members of the military. So is that going to be the inflection point? Potentially. There also could be some wiggle room with the money that Congress has appropriated to the Defense Department. You could see, I think, President Trump trying to dip into that money to pay service people. So that date could come and go, and the government can still be shut down.
And what about the billions the farmers are supposed to get? When do they get them if the government is shut?
Yeah, I mean, that is also an open question. And again, not to be so negative Nancy here, but you really do need to go to Congress in order to allocate that money as well. There's some fungibility in terms of the ag budget, but really for the amount of money that the president is talking about, $50 billion for farmers, you would have to actually have
the money's not there right now.
The money is not there, and you need Congress to actually allocate that. So I think that, the big question though for our clients, for our traders, is this a market event? And of course, I think that, the conventional wisdom, which I think is right, is this is not really until it is, right? This is not going to be if this is just a 2-week shutdown. But once you get kind of past that 2-week period, of course, this is a full shutdown, meaning that they haven't passed any appropriations bills. So, BLS is shut down. Obviously, the Department of Defense is shut and what have you. And that is when I think there is a risk of you get this sort of non-linear economic effects, right? A tenth of a point being shaved off of GDP a week, not necessarily a big deal. But once you actually have a prolonged shutdown, you sort of have sunk costs in terms of lost GDP activity. So that is I think, again, maybe a caution to this very bullish market is that if this is prolonged, which it looks like it could be, then you could get into a territory where it is different because we actually haven't had a full shutdown ever past 16 days.
You mentioned the government being comfortable with the situation right now. I think Wall Street is too, because basically, given all the ones you've seen, it's growth delayed, not derailed. Now, a key question this time around is whether the furloughs are actually firings. Do you think it is going to be one versus the other?
Yeah, and I think that is obviously, this labor market, as you all very well know, pretty fragile right now. So could this be yet another shock to that labor market and could sort of tip over? Our economists are saying that there are a lot of indicators that look sort of pre-recessionary, not necessarily that we're going into a recession, but if you just look at sort of the fragilities behind some of these labor market statistics, that it's looking sort of similar to 2008 or 2000. Will the furloughs turn into firings? I think that's a sort of an open question. I think there's a political dynamic there. I'm not sure this really reads well for the president. So, is this more bluster and the kind of reality is much different? That's what I would sort of suspect. But again, kind of open question. And if this goes for a long time, then I think kind of all bets are off, honestly.
That would certainly change how people think about the economic impact, the consequences.
Absolutely. And so far, the threat hasn't worked in terms of, I'm still watching the senators from Virginia and Maryland, and they haven't caved yet. And they're the ones that are going to be hurt the most when it comes to a government shutdown.
Libby Cantrill of Pimco. Libby, good to see you.
Thanks so much.
Thanks for dropping by. Thank you very much. Not just on the government shutdown, but also this major move in the pre-market of a name that many of you, including myself, had never heard of. Trilogy Metals in the pre-market up by more than 200%. We joked a few times. We mentioned it earlier on this morning that there's going to be a lot of investors out there going through all of these different mining companies trying to work out who's next.
You know what I'm doing late at night when I come in, I'm tired. I'm just trying to figure out who is going to be next, because this administration has made it pretty clear what the direction of travel is. If you have any stakes in raw materials, if you can have copper, steel, anything that the United States needs to get its hands on when it comes to, because they can't get on right now with China, they're going to take a stake. It doesn't matter if there's only 5 employees at the company.
Big move in early trading. Coming up on the program, we'll catch up with Kipp deVeer of Ares Management as massive investments feed the AI boom. Plus, Yahara has your morning movers. Oscar Health rising on possible talks in Washington. The stock is up by 6.5%. Not used to this. Over the last week, things have been pretty electric, particularly yesterday morning. This morning, unchanged, bit snoozy. Equities going nowhere on the S&P 500, likewise on the Nasdaq 100. Let's get you an update on some single names, your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. NVIDIA has the Midas touch. Shares of iron are soaring 8% after the data center company said it secured new multi-year cloud contracts to deploy NVIDIA's Blackwell chips. And in a sign of strong demand for those chips, Iron says that customers are signing deals before those chips are even delivered or installed. Meanwhile, moving on to Intercontinental Exchange, this is the owner of the NYSE. Shares are up 3% on reporting that it is in talks to invest $2 billion into Polymarket. The platform, of course, is known for allowing customers to bet on yes or no questions on everything from sports to pop culture, and famously was known for correctly calling President Trump's 2024 election win. The Wall Street Journal reports a deal could come as soon as today. And Oscar Health shares are rising 6.75% after President Trump signaled that he might extend Affordable Care Act subsidies as part of a deal with Democrats to end the government shutdown, since ACA plans are a big revenue source for insurers like Oscar Health. Cutting the subsidies could be detrimental for the company. So these latest developments offering investors a bit of hope. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, President Donald Trump briefly signaling he's open to shut down negotiations before walking that back, and saying Democrats must first reopen the government. Both parties remaining at odds over healthcare subsidies. Elsewhere, Trilogy Metals soaring this morning on news that the US will take a 10% stake in the Canadian minerals explorer. It's part of a more than $35 million investment to secure critical energy and mining projects in Alaska. And finally, the Trump administration also planning to unveil new support for US farmers struggling with tariffs and trade disputes. The potential bailout package could be worth more than $10 billion, but it's not yet clear where the money's going to come from.
Libby Cantrill from Pimco was dead on about this. They could draw from a fund they have, but the reports that only about $3 or $4 billion is left in that fund. So to get the remainder, if you want to give the farmers a $10 to $15 billion bailout, which likely they're going to need given the fact that China has not signed up for any cargoes, you're going to have to go to Congress. And the problem right now is we're in a government shutdown, and to everyone's point, there has been no urgency at the moment to reopen it.
And then we get closer to the midterms, and the pressure continues to build, not just from the farmers, but also consumers who might want some relief as well. And you wonder what comes next.
Yeah, and also you think about potentially also, Jonathan, another pressure point we haven't talked about today. What's going to happen when it comes to the FAA? You already see the transportation secretary saying you are expected to show up from work. No more sick days. You have to be at work even though the government's shutting down. When you start to have delays on flights, that was the pressure point in 2019.
Do you hit the inevitable pressure points and this story ends? Is it the same story as usual, or is it ultimately somehow different this time? That's the latest on the government shutdown and other stories too down in Washington, D.C. Let's get you the latest on tech. AI investment very much in focus. Lisa joins us now from the Greenwich Economic Forum with a special guest. Good morning, Lisa.
Good morning, John. Yeah, here it is not a government shutdown. It's a beautiful morning in front of a beautiful waterfront. And I'm here with Kipp deVeer, who's the co-president of Ares Management, which oversees almost $600 billion. And Kipp, thank you so much for being with us.
It's great to be here.
I do want to start where John was talking about this idea of the tech build out and how much private asset managers have been instrumental in that. I'm just wondering how much you are continuing to accelerate your investments into digital infrastructure, given that everyone is worried about an AI bubble. Are we investing too much? Are we seeing the fruitions of our money?
Sure. So we've sort of transitioned that business to be broader in its scope. Historically, we've been largely a lender to the space, so a senior lender and a mezzanine investor as well through our debt infrastructure business. We did a recent acquisition that you may be aware of a business focused on industrial logistics investing, mostly in Japan, but it's global, and they have real digital infrastructure development capability. So we've started to roll that out. We've done 2 completed projects now in Tokyo. We have a 3rd underway just on the outskirts of London. So we're getting more active on the development front. I think that the measured approach that we've taken getting into the market doesn't, frankly, put our investors at risk, right? Our goal is to generate great returns for our investors. So we think if you stay in tricky markets, i.e. hard to find entitled land, and then you're building really high quality facilities, which we think we are because we have an in-house team that came with the acquisition, it's pretty easy for us to find great leases from investment grade tenants like the hyperscalers.
Are you passing up opportunities that concern you? Do you see things out there that do worry you?
I think we're selective, and I think if you look historically in areas like this over the last 20 or 30 years, typically when this much capacity comes online, some of it at the end of the day is going to have to be marginal, right? These trends tend to lead to overbuilds in certain places, so I think us being selective and being measured in what we build is super, super important.
One thing that we've seen over the past 5 years is an incredible consolidation of market capitalization of the biggest asset managers, the biggest private asset managers. I'm thinking of the ones that you won't name, like Apollo and KKR, and of course Ares.
I'll happily name them.
I'm just wondering whether you think this is the sort of path to follow, that you think the biggest are going to only get bigger and dominate the space.
Look, I mean, we've believed since the beginning, frankly, of the company that the more scaled platform, both in terms of diversity of asset classes, but also diversity of geographies, was a huge advantage. Right? So we think we get better information, we participate in more markets, we probably do better due diligence because we have better access points. So I think the both investing advantages, but also the capital raising advantages are real, and you see that with the growth of Ares, with the growth of Apollo, and the growth of all the Blackstone, KKR, all these folks that have consolidated share for sure.
You just actually did see another record year for fundraising, and it feels like it's accelerating with respect to how easily it is to really get interest from investors. What's sort of been the tipping point? Where are you seeing that interest really coming from?
Yeah, I mean, we grew up raising most of the capital from the firm from institutions. So it was pensions, sovereign wealth funds, et cetera, and we've really diversified the way that we raise capital today. So I would say an increased focus on the wealth channel, for sure, an increased focus on what our insurance clients are looking for, because they're very challenged in a tight spread, lower rate environment. So it's just become more and more diverse, and I think as we're able to educate and offer access to investors that didn't have access to certain products before, there's just a lot of uptake from a new set of clients that are interested in what we can deliver at Ares.
How much is that going to be turbocharged by some of what's coming out of Washington, D.C. to open up some of the private asset management field to 401k accounts?
Look, I mean, I think our view is that it's probably a ways off for that to really provide a lot of lift, but we are incredibly supportive, obviously, of bringing our products into channels where there's interest. And I do think that those groups of investors today who have not had access to alternatives deserve access to alternatives.
So right now, one thing that is another theme for the year has been American exceptionalism and this question of, is it still the best place to invest? And I wonder, as the co-president of Ares, whether you see the greatest opportunity in the United States or whether you increasingly are expanding overseas, that you see better investment opportunity there?
Well, I mean, so I think holistically, we've been looking to expand geographically for a host of different reasons, just to give our investors more access points in terms of geographic diversification and asset class diversification. But to actually answer your question, I do think, despite some of the instability that people may feel here, that most of the investors that we see around the world are most excited still about investing in America.
It's one thing that we've seen sort of this idea that everything was going to fall apart in the first half, and suddenly we're talking about a reacceleration, and suddenly the M&A that everyone had been expecting is coming back online. We're actually seeing those deals come to place. How active has it gotten for you? I mean, how much are you seeing this in your business?
So, I mean, look, the first 3 to 4 months of the year were pretty rocky, particularly up through April, and that really slowed transaction volume everywhere. But I'd say in most of the asset classes that we're in, everything has rallied back to where it was pre-Liberation Day and even through that. So credit spreads are incredibly tight, whether you look at high-grade corporates or high yield or loans. The equity markets are obviously up through highs. The thing that we're most excited about is actually kind of a shift for folks that see maybe some of those markets as expensive into some of our real assets businesses. So the recovery in real estate, which we think is real, is offering a lot of opportunity for us to kind of play into the sectors that we like. We refer to kind of as the new economy real estate. So that's industrial, that's logistics, it's self-storage, it's multifamily. And we're seeing, we talked about it for a moment earlier, a lot of investment in the infrastructure space, whether it's traditional or digital.
How much is that predicated on the idea of Fed rate cuts, or how much is that completely independent and a sort of secular bet on some sort of shift in the economy?
I don't think it's particularly, reliant on rate cuts. I think rate cuts help equity more than it helps credit and lending businesses. So our own view is the yield curve is probably over predicting cuts. I frankly think the economy here is pretty good. And policy, while it's a bit restrictive, doesn't seem to be slowing too much down here in the States. So transaction activity is picking up, and valuations, as I mentioned, have recovered in almost every asset class. So I do think we'll see a slow decrease here in rates to try to provide some relief and keep the economic growth that's slowed growing. But my own view is I don't think rates are going to go down as quickly as maybe you're reading about in the newspaper.
So I have a feeling I know how you're going to answer, but what concerns you more? Some sort of downturn in the next 6 months or some sort of reacceleration in inflation?
The latter. The latter. I mean, I think we see the economy is good, although the growth has slowed. And that's partially as a result of rate increases, by design to obviously try to deal with inflation. But I think that the real scary moment is that if you see a reignite of inflation and the Fed has to really dramatically rethink their policy, which I think has been one to leave rates where they are / reduce them a bit, which is obviously going to accommodate more growth and more rise in valuation.
Kipp deVeer, thank you so much for being with
Lisa.
us. This is really fun. Let's do it again.
Appreciate it.
This is Kipp deVeer, of co-president of Ares Management. John, I'll send it back to you.
Lisa, thank you. Great work as always. More from Bramo in just a moment, so stay tuned. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Lizzie Burden for more. Hey, Lizzie.
Hey, John. Representatives for Israel and Hamas have begun discussions over a deal that would free all remaining Israeli hostages in exchange for thousands of Palestinian prisoners. US President Donald Trump is pressing Israel and Hamas to secure an agreement as the war hits the 2-year mark since it began. The talks are set to continue for a second day in Egypt. Elsewhere, Elon Musk has appointed former Morgan Stanley banker Anthony Armstrong as the new CFO at xAI. The Financial Times reporting that he'll head up the finance function for both xAI and social media platform X. Armstrong previously worked for the Trump administration as a senior advisor to the Office to Personnel Management as Musk enacted Doge cost-cutting efforts. And Ford is facing months of disruptions after a major fire at a New York aluminum plant. The Wall Street Journal reports that the company will likely outline the fallout in its quarterly earnings this month, and a large part of the facility will be out of service until early 2026. And that's your Bloomberg Brief. John?
Aluminium, aluminium. You see Lizzie there? Getting sucked in. It's easy to get sucked in.
It's very
All of a sudden it's aluminum, then it's sidewalk.
It's aluminum for you. You're you're fully sucked in.
I've been here 10 years. I'm fully bought in. I'm not going anywhere. Lizzie, thank you. Appreciate it. Up next on the programme, neither party is stepping up to the plate.
Neither party is stepping up to the plate to deal with or grapple with the reality that the United States needs to endure a fair amount of fiscal reform to be on a path for long-term sustainability.
Up next, we'll catch up with the Connecticut Governor, Ned Lamont, from New York City this morning. Good morning. You're watching Bloomberg TV. Spent the whole commercial break taking abuse. You finished now.
There are some British words that I just find so ridiculous that you should just say the American English version, like the word schedule. It's not schedule.
I say
it is
schedule.
I know.
I say
so you're
schedule
fine,
all the
but
time.
you're one of us now.
Okay, thank you. Thanks for adopting
Welcome.
me. All right. Equities on the S&P 500 just about unchanged. Likewise on the Nasdaq. Likewise on the Russell. Unchanged after hitting fresh all-time highs to kick off the brand new trading week. And believe it or not, we've not had a single down day for the month of October. Let's see if that continues.
I think it's called Uptober.
Uptober. Nice.
Yeah.
Is that yours?
No, I think that's people on Twitter.
Okay, I've not seen that one. Okay, that's a new one. All right, record highs coming into Tuesday morning. Under surveillance this morning, neither party is stepping up to the plate.
Neither party is stepping up to the plate to deal with or grapple with the reality that the United States needs to endure a fair amount of fiscal reform to be on a path for long-term sustainability. The shutdown is symbolic of a different problem, which is the dysfunction between the Republican and Democratic Party on resolving issues with respect to the budget of the United States of America.
So here's the latest this morning. Wall Street growing frustrated with Washington, pushing for fiscal reform as the shutdown enters its 7th day. Lisa joins us now from the Greenwich Economic Forum with another special guest. Hey, Bramo.
Hey, John, thanks so much. I am here with Governor Ned Lamont of the great state of Connecticut in this Uptober. Is that what Annmarie called it? In Connecticut, in the Del Mar Harbor. And Governor, thank you so much for being with us. I want to start with something that's an increasingly hot topic. We're here at a leader of businesses, with the leaders of businesses who oversee huge portfolios of money. How, as governor, do you keep attracting this type of business to a state while providing some of the social services and other expenses that cause taxes to go up?
Well, the folks here at the Greenwich Economic Forum are really important to the state, and the fintech sector, the financial services sector, a big piece of our economy. We're part of the New York City financial ecosystem. I think what they like here is a little bit of certainty and stability. They sort of know where the state's going to go. Our taxes are a little bit less, and it's not a bad lifestyle.
Are you concerned about what would happen if, say, there is a changeover in the leadership in New York City? Let's say mayoral candidate Zohran Mamdani does win and implement some of the policies that he puts out there. Are you concerned about the ramifications for a place like Greenwich, which really relies on the ecosystem of the tri-state region?
A little bit. New York City is the financial capital of the world, and we're a big piece of it here, as evidenced at the Economic Forum. And I want to make sure that the next mayor understands how important New York City is to that system, and that's important to Connecticut.
How concerned are you about who the leader is in the Democratic Party right now? Do you have a sense of where the leadership really is coming from?
Governors. Okay, I'm a little loaded for bear on that. I like governors. Governors have to get stuff done. Governors have to balance a budget. They have to do it on time. Governors can't shut down a government. Governors are sort of the opposite of what you see going on in Washington, I think, on both sides of the aisle. But in our case, the Democrats see real leadership coming from the governors. But don't ask me to ask names.
Well, but I'm wondering, though, how does a governor take that leadership when things are shut down in Washington, D.C., and when it seems like there's a real fissure right now in the party, in tactics, in approach, in platform?
I can tell you the governor's incredibly frustrated. Democrats are louder about it than Republicans. You know, we balance our budget, but we do it based upon some assumptions in terms of what our relationship is with the federal government. If they pull the rug out from under you every week, seems to be happening right now, it makes it very difficult for that certainty and stability that the people in this room like.
How much have you seen actual ramifications from the government shutdown in the form of funding that isn't coming through?
It's not my first rodeo with these Trump shutdowns. So we went through all of our commissioners. We saw what's most at risk, where do you have reserves, WIC, which is women, infant, and children. Probably only had a week's worth of reserve there, so we figured out how we backstop that. SNAP, which is, food benefits, that's the end of this month. So we're watching very carefully where the risk is. And I can't make up all the shortfall, but I'm trying my best to help out the most vulnerable.
Well, how long do you have reserves to cover things? In other words, when does the funding run out? Should this shutdown continue for a long period of time?
End of this month. SNAP benefits is probably $75 million a month. I can't not make up that shortfall. So if the federal government walks away, that's tough. If we had assurance the federal government's going to backstop, if we had to help it out for a couple months and we'll get paid back, that's something else. We have none of that assurance.
I guess I want to go back to the idea of leadership right now, because we are beginning the midterm election cycle. And I wonder, as a Democrat in your second term as governor, how much do you feel allegiance to the Democratic Party versus something else, amorphous, that's coming that doesn't necessarily have a label?
Well, as governor, you feel strong allegiance to your state. I'm a homer for Connecticut. I'm Team Connecticut. And, Republican or Democrat, I try and get stuff done. Personally speaking, as I look at a lot of the Civil War down in Washington, D.C., and I look at L.A. and I look at Chicago, I do think it's important that the Democratic governors stand and speak with one voice, that, what we need from the federal government in terms of a reliable partner.
How much are you concerned about some of the images that we're seeing with the National Guard going into places like Chicago and San Francisco and Portland, and really raising a question about whether it's going to be the states versus the federal government?
Ray Dalio will be speaking again. Remember a year or two ago, he was talking about Civil War, where you go, oh, Ray, come on. It's a little bit unnerving if you see those images right now. I talked to General Yvonne, the head of the Connecticut Guard. We're very careful. I said, any inquiries from the federal government? I don't know. We just sent our guard to Djibouti, not to Chicago. I feel pretty good about that.
Going forward, what is your plan to try to keep businesses here and attract them to the Northeast, given the exodus that has gone to Florida, to other places that have lower taxes?
We are speeding up our rail system from, say, Greenwich to Grand Central. That'll be 10, 15 minutes faster. Working really hard to make sure you can get the workforce you need. And again, we haven't raised taxes in 7 years. We've balanced the budget. I think that type of stability is pretty helpful.
Do you think that taxes need to come down? Do you think that that's an instrumental part of trying to keep attracting businesses and compete with other states?
Well, I'm a governor, so I can't overpromise. Everybody running against me is always saying they're going to eliminate the income tax in the state of Connecticut. I think what's more important to the folks I talk to is, what's the state going to look like 1 year and 5 years from now? Do I want to be here because I'm making a 5-year bet? We haven't raised taxes at all. I've cut them for middle-class folks. I think that's a good balance.
Going forward, what is your number one hope for the state? What is your number one sort of policy platform that you're hoping to get forward over the next 1 to 5 years?
I need housing. For the first time in a long time, a lot of young people are moving out here, like the lifestyle. We're pretty good as a suburban lifestyle, rebuilding our cities. These are cities were 50% bigger 50 years ago. Now they're growing again, where young people want to be. As I talk to the businesses to say, is this a place where young people, young employees want to be? I'm trying to say yes.
How much are you participating in the reindustrialization of the United States? I mean, that's been a big platform that we've seen overall. Is that something that you're trying to attract to the state as well?
Yeah, I'd like to think of us as the Silicon Valley of manufacturing. We do a lot of complicated stuff like submarines, jet engines, and choppers, and they're growing fast. That's the sort of the heart of our economy in the northern part of the state. But, that's changing too. It's getting increasingly energy intensive, so I'm going to bring down the price of electricity as best I can and make sure they have the workforce. It's all sort of an AI computerized workforce now.
Governor Lamont, thank you so much for being here. Wonderful to speak with you here with Governor Ned Lamont of Connecticut as you hear the seagulls cawing overhead. Back to you, John.
Lisa, you enjoy yourself. Have fun. Lisa, thank you very much. Thank you. Sounded like the Democrat from Connecticut was worried about the Democrat in New York City.
Yeah, Zoran Mamdani. He's worried about potentially what this means because of obviously the driver of business and growth New York City is to all the tri-state area, whether that's Long Island, New Jersey, Westchester, Connecticut, the commuters that come in and out. Also, though, it could be a huge boost for Connecticut in terms of people that maybe want to flock and live somewhere else. That's what people are saying. Potentially, they'd want to leave New York City.
The election weeks away. More from Lisa throughout the day from the Greenwich Economic Forum, so look out for more on that. Special interview also later on this morning. Jamie Dimon sitting down with Bloomberg's Tom McKenzie over in London. That conversation about 3 hours away. Coming up on this programme, in the next hour, we'll catch up with Brent Schutte of Northwestern Mutual, William Stein of Truist Securities, Stephanie Roth of Wolfe Research, and Ohsung Kwon of Wells Fargo with a new price target on the S&P 500 over at Wells for next year. We'll get into that in the next hour. From New York City, you're watching Bloomberg TV.
The reality is the AI boom is real.
AI has the potential to be very important, but no technology gets adopted in a straight line.
We need to see a heck of a lot more, particularly given the amount of spending that is going to be done over the next couple of years. I don't think the spigot turns off in 26 or 27.
You are seeing a broadening out. Our most preferred way to pace structural growth is through tech.
For the moment, the trajectory is very much towards corporates still being in a relatively better position.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs on the S&P, the Nasdaq, the Russell. Futures positive on the S&P, the Nasdaq, and the Russell. Advancing once again following a 7-day winning run on the S&P 500, the longest daily winning streak going all the way back to May of this year. That's the story in equities. The story for the week ahead shaping up as follows. We're going to be light on data once again with the government shutdown, so we're looking ahead to earnings from Delta on Thursday. Then a week today, earnings from JP Morgan. To hear from the man himself, Jamie Dimon, the CEO and chairman of JP Morgan Chase. Stay tuned, 11:40 Eastern Time, speaking to Bloomberg's Tom McKenzie about Bloomberg technology and a whole lot more.
Well, when you think about it, what is he going to be asked? Obviously, when it comes to technology, are we in a bubble right now? And I love what Ed Yardeni had to put out this week. There's certainly a bubble in fears of a stock market bubble, especially in technology stocks. So there's this push and pull, real division we see playing out in real time on whether or not people think this is potentially a bubble. When you look at deals that are being done like AMD, OpenAI, NVIDIA, a circular market, it gets people concerned. At the same time, it is promising to really transform this economy.
There's so much economic activity going on right now. We saw this through the month of September. Lots of debt supply, lots of paper starting to move. We saw the agreement, a bank purchase taking place, some consolidation in the regional bank sector in the last 24 hours, the AI announcements as well. The C-suite's moving on really, really quickly. 6 months ago, we were obsessed knee-deep in tariffs and what the trade story would mean for corporate America. If you want a flavour of that now, you need to listen to the C-suite, the banks, what they're saying, what they're seeing, because you're not going to get it from the data.
And where they're hiring. They're hiring right now in investment banking because everyone is lining up to get deals done that they felt they couldn't get done for the past 4 years. The deregulation push is actually happening in Washington. So CEOs have really moved on from the tariff story, and in 2026, they want to move on to the M&A story.
Yesterday it was Fifth Third and Co. America. Tomorrow, who knows? Coming up on this programme, we'll catch up with Brent Schutte of Northwestern Mutual as stocks trade near record highs. William Stein of Truist, as he calls AMD a real partner in the AI market. And the US Senator Bill Cassidy as the government shutdown enters day 7. We begin this hour with stocks eyeing an 8th straight day of gains as the AI spending spree continues. Brent Schutte of Northwestern Mutual Life Insurance writing the following. While the budget battle led to frozen funds in Washington, an artificial intelligence-fueled deal-making spree has fueled no shortage of investor confidence. Brent joins us now for more. Brent, welcome to the program. Are you starting to question that confidence?
Yeah, I think so. I think there's lots of comments about 98, 99, and people use more anecdotes than anything else. Let's look at some data. The narrowness of the market is the same as it has been since back then. So 98, 99, 28 and 32% of the S&P 500 names beat the index, same as 23 and 24. Small and mid caps traded the same relative valuations they did back then. The Cape ratio, which is the price that you're paying for the earnings overall, second highest level in 150 years going back to 1870. Price to cash flow. So I hear so much about the cash flow these companies are earning versus back then. You're paying levels of cash flow on the tech sector that you were back in September of 1999. And so if you look at all these different things, I think there are a lot of echoes of 1999, and that's where I have concerns about what happens going forward.
What do you think happens going forward, Brent?
I think investors should focus on the economy broadening back out and the markets broadening back out. And so I hear lots of commentaries about why small and mid-cap stocks can't outperform. I heard the same things way back in 1998, 1999. I think about international stocks, which were similarly dead back then. And I think about the dollar potentially pushing lower in the future, which at least historically has been the biggest determinant of what happens in U.S. versus international equities. And if you believe the dollar is headed lower, you might want to have some international equities in your portfolios. And so I think there are a lot of echoes, a lot of similarities, and I think opportunities exist. They are just in places that people aren't looking for right now. And I think much like then, AI will become something that does benefit the entire economy and all the companies that operate in the economy, which is where that broadening thing, I think, really comes to fruition.
While other opportunities might exist, don't you also want to be exposed to what is going on, given the fact that every single day these companies are notching new record highs?
100%, but you don't want it to be your whole portfolio. And that's my worries right now, because when I travel around, people only want to be invested in those parts of the market. That's where I hear people come on your show and essentially kind of talk about that as if that's the only opportunity that's out there. Look, it can go higher. That is no doubt. I don't know when it's going to stop, and that's the problem. And that's where I think anybody who thinks they're going to know exactly the date that you need to actually get in those other parts of the market because you have hit some level of kind of peak optimism on AI and in those names, that's where I think they're fooling themselves. Plus, if you think about it, we have to broaden back out at some point. I don't think the economy can continue to be this narrow. AI will become something that's obviously very important to the U.S. economy, but is that already discounted in the prices of those stocks? And do the winners change in the future, which I think the answer is yes.
Jeff Bezos talked about on Friday that investors have a hard time in the middle of this excitement, really between distinguishing between the good ideas and the bad ideas. What are the characteristics of each of those playbooks?
Yeah, I mean, that's just where I don't know if people know what the exact winners are going to be, or how this is going to play out in the coming months. I even think about the economic data right now, which I never thought I'd get on a TV show, and we wouldn't be talking about the potential for a contraction when the average job growth is less than 30,000 by any single metric. You can look at ADP, Revilio Labs, which is something you all brought to life last week. And that's where I just think that's kind of an odd period of time. At the same time, you have inflation, which is pushing higher, not lower. And the Fed is expected to cut rates. We haven't been at their 2% target for some time. The CAPE ratio is at 150-year highs besides 1999. And yet there are no fears that are out there. And that's where I just want people to behave just a bit better and make sure they're ready for whatever comes next, because I do think that there are some risks that are out there that are not currently priced into the market in any way, shape, or form.
Brent, the situation you described, though, isn't that precisely the reason this is such a fertile environment for taking risks right now, that we have had a step down in payrolls growth? The Fed is responding to it and will continue to respond to it. At the same time, the earnings profile of the big weights of the S&P 500 is still quite robust and solid. So you get both the earnings and the rate cuts. Why wouldn't you want to be in these names?
Look, that's where I think you could sit us at any point in the past in time periods like this. And I think there's this unfettered belief that the Fed can save every economic cycle. And that's where I'm just not for sure that occurs. And so that's where I just advise people to be a bit cautious. This does not mean that you go out and sell all your equities. It's just that you're at whatever level of equities that your financial plan says, and that you stay diversified. I think there are more outcomes that could occur. Everything going well could be an outcome that occurs. I think inflation could be an outcome that occurs. I think on the opposite side, you could actually have an economic contraction, because at least historically, the labor market is the canary in the coal mine. And that's where I'd advise people to stay diversified, stay invested, and continue to think about the future. And that's where I like to focus on relative valuations in times of unknown. And that's where I think small and mid-cap stocks trade at those valuations relative to the large cap counterparts that they did back in 1999. And if you look at the past 25 years, mid-cap stocks have outperformed the U.S. large cap market by 2% and small caps by 1.8%. And that was from those lows of 1999.
Brent, just build on this just a little bit more. Diversification in 2025 and what that actually means. I remember when playing utilities was actually defense, and now it all feels like precisely the same trade. How different is the story now?
On the diversification trade, I mean, I think to me, diversification means that you invest for uncertainty, and concentration means that you think you know exactly what's going to happen. And I don't think there's anybody who's going to come on your show that's going to know exactly what's going to happen. I think there are echoes of 1999, and that's where I would encourage people to stay invested in those names, but don't make them your entirety of your portfolio, which is what I see individual investors wanting to do. They don't want to own anything outside of that. And that has echoes of 99, that has echoes of 06. And that's where I think these narrative that Wall Street kind of comes up with to support whatever thesis they have oftentimes gets cold water thrown on it.
Brent, appreciate the update. Your reaction as well. Thank you, sir. Brent Schutte there of Northwestern Mutual Life Insurance. Cautious on this equity market. Wants to stay invested, but worried about the consequences of a market that's become too concentrated.
He's cautious because he's looking at potentially the history doesn't repeat itself, but certainly rhymes, and what potentially this could mean when we had, the internet bubble, the dot-com bubble, and all of the losers we saw out of that, and the people who got absolutely burned. And so many of those people are still in this market today, and they're starting to feel the same sort of exuberance they felt in the late 90s. They're feeling it now, and that is why there's some caution.
Nasdaq futures this morning up by another 0.1%. With an update on stories worldwide, with your Bloomberg brief, let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. The Trump administration is expected to announce a plan as soon as today to bail out U.S. farmers impacted by the ongoing trade war. The rollout may be impacted by the government shutdown and could hinder congressional action needed to approve the payout. Sources say that the bailout could total between $10 and $15 billion and could be followed by additional aid. Elsewhere, New York Stock Exchange owner Intercontinental Exchange is in talks to invest $2 billion in Polymarket. The deal could value the popular betting market between $8 and $10 billion and could come as soon as today. Polymarket drew attention, of course, last year for its betting market on the presidential election. And Wegovy maker Novo Nordisk has laid off dozens of employees at its largest US manufacturing site. That's according to Reuters. The previously unreported cuts included roles from quality control to production line technicians. The company hired its new CEO, Mike Dutta, in late July. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in about 30 minutes. Up next on the programme, the Morning Calls Plus, William Stein of Truist, as he calls AMD a real partner in the AI market. That conversation up next. Live from New York City this morning. Good morning.
I don't say bubble. I never say bubble. I think that there's a lot of enthusiasm. People feel, I mean, there's certainly a bit of a chase, right, where people feel like they need to, buy into the technology. There is some of that. But, the market seems to be, there's sort of new economy dynamics, right, at least for AI. Is that necessarily wrong? I'm not sure.
That was Neil Dutta of Renmac saying essentially be more focused if you're the Federal Reserve on what's happening in the labour market and the downshift in payrolls. Neil expecting this Fed to do a whole lot more. Maybe not this side of the new year, but certainly into 2026, you're going to see a more aggressive Federal Reserve as the labour market weakness boils to the surface just that little bit more.
And really fascinating because we are in a data desert with the government shutdown. Carlyle releasing its own estimates for U.S. economic data. Jonathan, this is not good, including an estimate of 17,000 jobs created in September. That's it, 17,000. If you're the Federal Reserve and you get a print like that, you're cutting interest rates.
Still waiting for the payrolls report. Not sure when we'll get that. The government's still shut down. Unsure if we'll get jobless claims this coming Thursday. CPI a week tomorrow. Waiting for the inflation report as well. So this Fed could well be flying somewhat blind as they get round the table together to meet for that two-day meeting at the end of this month. That's the situation with the Federal Reserve. Here's the situation with financial markets. Equity futures on the S&P 500 on a 7-day winning run. The longest daily winning streak going back to May of this year. Futures just marginally positive on the S&P. On the Nasdaq 100, all-time highs at a close yesterday. Thank you, AMD. Their stock is up again this morning. And that index is up by close to 1/10%. That's the price action. Let's turn to the morning calls. That one stock in focus, AMD. First up, UBS, raising its price target on the stock to 265, saying the AI trade still has legs given the infrastructure build out. Your second call from Morgan Stanley, raising its price target on AMD to 246, noting the OpenAI deal will boost its chip ecosystem. And finally, Jefferies upgrading AMD to buy, saying its OpenAI deal is a, quote, multi-generational opportunity. Let's stick with AMD. The stock adding over $63 billion in market value after landing a blockbuster deal with OpenAI. William Stein of Truist has a buy rating of 273 price target on shares of AMD. He writes the following: while AMD was previously cited as a price check to NVIDIA, it is now cited as a true potential partner. Will joins us now for more in the studio. Will, good morning.
Good morning.
We'd just like to start by giving you some space and time to reflect on the deal that was announced yesterday. Were you expecting something along those lines?
So I don't think this was a surprise in the sense that we've written about this change in sentiment in the way the supply chain partners are recognizing and the customers are recognizing AMD for its increasingly competitive products and solutions and the ecosystem that they're trying to build out relative to NVIDIA. So not surprising from that perspective. It was certainly a surprise in that we didn't expect the magnitude and the timing and the details of this deal, which are extremely positive. And I think the stock's reaction is sensible relative to the size of this deal that's announced.
Maybe it was a Freudian slip, but is AMD now mounting a real challenge to NVIDIA with this type of deal?
It's a challenge to NVIDIA, perhaps. I think that's a fair way to say it, but it's not a challenge for leadership, in my opinion. I still think NVIDIA is the company I call the AI company, and I think that remains the case. I think the question is how should we perceive AMD? Previously, let's say prior to a couple months ago, my industry contacts had always cited AMD as a sort of a price check. It's not for real. They may be getting $2 billion this year, maybe $5 billion in data center. But from my perspective, I wouldn't value that as sort of an underwriting of ongoing revenue and profitability, because my perception was, look, in a couple of years, it could be a zero. And that's what shifted a couple months ago. And so an attack or a leader versus NVIDIA, no, but a real alternate, a true potential partner as a supplier, I think that's the way to think about AMD.
Does it worry you that all of these deals are so circular?
Look, it's not lost on me that there are heightened risks when the seller of technology is also financing the buyer. However, we've seen this for a number of years. The first time I heard about this happening in this industry was with NVIDIA essentially funding the cloud service providers to help it build out this thing they call DGX Cloud. This made me quite nervous. But here we are several years later, and when we look back at those transactions, it does not appear that they were set in motion in order to inflate revenue. To the contrary, these were sensible deals with real business rationale that drove technology forward for NVIDIA and for all of its customers. And we think the deals that are getting announced now are similar to that.
The stock is up again this morning by 3.9%, sort of a major move in yesterday's session. Off the back of that move, I imagine there's a green light for other companies to say, we need to strike the same kind of deal with OpenAI. Let's get moving. What are the prospects of another company doing the same thing? An Intel, say, getting involved in something like this?
Yeah, I think for Intel, this is a bridge too far. Now, that's not to say that Intel doesn't sell anything to OpenAI. I don't know whether they do or not. I would imagine it's likely they sell some stuff to OpenAI, okay? But to become a major supplier of AI infrastructure, Intel just doesn't have the products and services that I think are required here.
You've got the two. Intel? What's missing there at the moment?
Oh, a lot. But let's start with an accelerator product. It's a processor that's sort of at the core of AI compute. These are often called GPUs. Sometimes they're called XPUs or ASICs. They're parallel compute structure processors. And the two main merchant vendors of these are NVIDIA and AMD. There is another route that these companies can pursue, which is called an ASIC or an XPU. And the major vendor there is Broadcom. There's another one outside of my coverage called Marvell, but those are the ASIC vendors. And it's my best understanding that OpenAI is already it has a deal with Broadcom for ASICs. And whether that's a fact or not, I don't know, but this is the widely speculated fourth customer of Broadcom.
It sounds like from what you're saying, the government investment in Intel is not going to solve the ultimate problem that company has. Is that fair?
Well, I think that's fair. I don't think it's a solution. I think the question is, how do other companies in the ecosystem, potential partners like NVIDIA and potential customers, react to this relationship that Intel now has with the federal government? And we saw, a view of this recently with the NVIDIA deal with Intel, right? This deal, makes Intel a supplier to NVIDIA for the sale of AI infrastructure to NVIDIA's customers. So they're essentially using some technology from Intel. Is that enough to save them? I don't think so. I think that's not to say that Intel won't succeed, but it's going to take more. What was remarkably absent from that announcement was anything related to manufacturing.
How difficult is that line to walk right now for these executives? I have been on countless trips with the president or in Washington, and Jensen Huang is there, almost dictating at times chip policy, what he wanted to see the Trump administration is actually doing. Are they going to come under pressure to help basically support Intel and potentially other companies that the U.S. government now wants to see be winners?
I'd have two comments to that. First, I think there is some pressure, and that may be why NVIDIA engaged in this transaction with Intel. Maybe. I don't really know. But the second point is to just take a little bit of exception with what you said. I don't know anything about Jensen's interaction with President Trump. I don't believe Jensen is dictating policy. For if he were, they would be selling lots of product to China right now. There's still a policy that prevents this.
Maybe I'm being a little bit snarky, but at the same time, Jensen Huang wanted to get rid of the diffusion rule over with the Trump administration. They wanted to get the H-20 trips back into China. Now, whether China wants to buy them or not, they are able to get that back into China. So a lot of things that he has been socializing are actually coming to fruition under Trump.
I think they're good policy. I think that's what's going on here. I don't know the degree to which Jensen influences Donald Trump. I really don't know. But I think these are good policies.
Well, before you go, wanted to finish and get your thoughts on what's been happening in this equity market more broadly. You've heard a lot of guests come on, including our last guest about 20 minutes ago, saying that there were echoes of the late 1990s. He was worried for investors and the concentrated risk, the bets building just around one or two companies, OpenAI, a good example of that. Is that a concern of yours? And what could you point to that would be slightly worrisome?
It is a concern. I think to brush that off is silly. I think whenever demand is very strong and has been for a number of years, as it has been in this AI trade since roughly 2020 or thereabouts, I think one has to always have an eye towards the next downturn. This AI data center cohort experienced that in 2019. It will happen again. The question is when and how bad will it be? I don't see anything on the horizon that suggests it's in the very visible future. For example, this year, next year, maybe 27. There don't seem to be any signs of that. The worrying signs, if we see them, are two things. One is a step down in CapEx from hyperscalers or like companies, so-called neoclouds, companies that are spending a lot on AI. If there's a slowdown or negative growth one year, that's obviously a big trip. The other is the ability for AI-linked startups to continue to get funding. If that has a sort of stall or hiccup, it's going to be a not so good day for these group of stocks. I can't so much talk about the wider market. Sure. You can make some interpretations.
Right now, the money's still there, that's for sure.
Yes.
Well, it's good to see you. Thanks for dropping by.
Thank you.
Thank you, sir. William Stein there of Truist Securities on that latest deal between AMD and OpenAI announced yesterday and that major rally we saw in AMD. Lots of concern, but ultimately one-way traffic for this equity market over the last 7 days.
Kevin Gordon, though, writes in, I love this. He says it's way bigger than 1998, 1999. As of the end of September, the 10 largest stocks in the S&P 500 made up 41.3% of the index market cap. That has to concern some people.
Nasdaq futures up this morning by 0.1%. Coming up on this program, the U.S. Senator Bill Cassidy as the government shutdown enters day 7. Live from New York City this morning. Good morning. You're watching Bloomberg TV. The opening bell about 60 minutes away. Your scores shaping up as follows. Equity futures on the S&P 500 just about positive. Likewise on the Nasdaq up 0.1% after closing at another record high in yesterday's session. Light on data once again this morning. Light on data all week potentially. Mike McKee can give you a look ahead. Good morning, Mike.
Good morning, John. Well, it is trade data that is missing today, the latest data from August, the updated data. The good thing is we do get an advance word on the trade deficit, and we did get that just before the government shutdown started, and it showed that the trade deficit has widened by, in goods alone, has widened by 11% this year. We are not exporting as much as we have been importing, even though during the last month we saw imports drop significantly because people had front-run the government. The one interesting thing is that trade imports from China are down 19% on the year. The biggest increase comes from Switzerland, 197% higher. That's because of all the people moving gold back and forth when they thought it might be tariffed. We go on from here to probably not get jobless claims on Thursday, and we will get the University of Michigan on Friday. But it's Wednesday's Fed minutes that are going to be the most important thing that we do get, because people are going to want to know, A, how Stephen Myron was received, and B, what people thought at the time on the Fed about the possibility of a rate cut in October and December.
Mike McKee with the latest. Michael, thank you. Breaking down the data you won't be getting later this week. This is what Stephanie Roth of Wolfe Research has to say. There should be very little impact to headline payrolls, but furloughed employees should be counted as unemployed. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
That's your take on the government shutdown. I just want your take on the lack of data. When does this start to become a problem?
Well, if we head into the Fed at the end of October, then it's a problem. Our expectation is you'll probably start to see some data, and of course they're going to roll out the employment data rather quickly once the government opens up, because the payrolls report was largely done. But as we move into the next couple of weeks, it starts to become a real issue. We really need to see the payrolls data. We really need to see the inflation data.
An issue because the Fed won't be able to make a decision, or just because they're flying blind without enough of the data when they say they're data dependent?
They're flying blind. And our expectation is the data over the summer, from a payrolls perspective, was not a great reflection of what's going on in the economy. Our expectation is that the trend in payrolls is not something like the 29,000 3-month average. It's closer to 60,000, in which case that's a much different picture because 60,000 is roughly the break-even pace.
When the data does come out, how difficult is it going to be potentially trust it? Because all the individuals that are set to be collecting data every single day are at home right now, furloughed.
Yeah, so the October data is going to be really bad. That, I think, should largely be dismissed. The positive is the September data is clean. So the data that we'll get initially will be a clean read of the economy. Then you're going to have another window where the data will not really be a very accurate reflection of what's going on. And then we can move into the November data. So the September data, especially from a payrolls perspective, will be helpful to gauge whether certainly we see August revisions higher because that's our expectation. A decent print for September is our anticipation. And then when we get the October data, you have not only the impact from the government shutdown, which, like you mentioned, those people will show up as unemployed if they answer the question correctly, and there'll be deferred resignations.
Have you got your doubts that they're answering the question correctly?
Well, if you looked historically, they didn't. It's unclear. It's a survey, and the BLS isn't supposed to change their answer. So if they answer incorrectly, they have to leave it that way. So it will be very unclear the impact on the unemployment rate. It could be a couple of tenths. It could be up to 4 tenths. But then we're going to also have the deferred resignation, 150,000 roughly negative payrolls for federal workers.
Any reason for the Fed to deviate from its dot plot, with or without the data, based on the projections last time around?
I don't think so. I think the dot plot is probably kind of accurate in terms of where we are today. Things haven't really changed that much. Of course, we don't have a clean read of the economy, but things don't appear to have deviated that much since the last set of data.
Did we have a clean read on the economy when we did have the data?
Yes, I think there have been a lot of revisions, and that's what's been driving a lot of the uncertainty. It's less about any sort of fraudulent activity happening with the data or it being incorrect in any other way, but there are a lot of revisions, partially because the response rates have been low. But once you get the second release of payrolls, then you have response rates back up to normal levels.
Carlyle has put out their proprietary data because of what's going on and the fact that we are in this data desert. And they are estimating 17,000 jobs only created in September. Could it really be just 17,000 jobs?
It could. Our expectation is it's probably a bit better than that. If you look at consumer spending data...
What's a bit better? 60
to 70,000 is kind of the ideal level right now. That's the break-even pace. That would be a nice steady state trend in payrolls. But so the 17,000 margin of error could easily be 60,000 as the actual trend pace. And if you look at consumer spending, we got big upward revisions to consumer spending in the last PCE report, and it tells you that consumers are still feeling largely okay, or at least they're spending with their wallets.
I'm glad you mentioned the consumer because we're obviously going into the holiday shopping season as well, if you can imagine, even though it's 80 degrees outside. When you say consumers are still spending, at some point, are tariffs going to be passed on to them?
At some point, but it's been a slow move into passing it on to the consumer. So our expectation is, when we track it, about 40% of the tariffs that we ultimately expect to get passed on have been passed on. It probably will never reach 100%, so call it we're half of the way there. So we'll probably continue to see it, but it will seem to be rolling out slowly, which is easier for the consumer to absorb.
Stephanie, it's good to see you. Thanks for breaking it down. Stephanie Roth of Wolfe Research on an economy without much data right now and what it means for the Federal Reserve at the end of the month. Let's talk about the government shutdown. I'm pleased to say that joining us now is the Senator from Louisiana, the Republican chair of the Senate Health, Education, Labour and Pensions Committee, Senator Bill Cassidy, joins us now for more. Senator, welcome to the programme, sir. Welcome back, I should say. There is a take on Wall Street that we've seen this movie before, that we get to the inevitable pressure points and the government reopens. You've done this for a long time. You've had this seat for 10 years. Senator, does it feel different this time?
It feels a little bit different because there's a complete breakdown of trust. Chuck Schumer, obviously he could end it tomorrow if he wants to end it, but he doesn't trust the president. That said, Chuck Schumer could end this tomorrow. I'm hoping that he does, and I'm hoping it doesn't take a lot of pain from the American people in order to get him to do so.
Is there a breakthrough in the fact that, and good morning, Senator, that it does seem like both sides, at least at this point, want to talk about talking, as Politico put it, that the president is coming out and saying maybe there could be a compromise when it comes to health care?
Yeah, I'm absolutely. You know, it's better to jaw than to war, as Winston Churchill once said. So let's go ahead and start talking. That said, Republicans have suggested a 7-week extension of the current budget to allow dialogue to continue. And that's commonly done, as Chuck Schumer points out, happened 13 times under Joe Biden. And so that 7 weeks kept the government open, allowed us to continue to negotiate. So I think there's something else that Schumer's thinking about. Not quite sure what it is, but I'd rather be talking than kind of sitting in our own corners.
What is going to happen, though, at the end of the year when we get this premium hike?
Well, first, we don't know what premium hike is going to occur. Let's just say that. But secondly, we've got to address the fact that the Affordable Care Act has become the Unaffordable Care Act, in which it takes huge subsidies in order to continue to make those policies affordable to Americans. That's wrong. We got to roll that back to a point where it's still affordable to Americans, but it doesn't require these huge subsidies. This is not sustainable. But by the way, it's not just me saying this. The Washington Post had an editorial about how the Affordable Care Act is no longer affordable. So I think now might be the time. What can we do to help the American public lower health care costs in a way which is not just for the exchanges, but for those in the kind of private markets as well?
Could you get a compromise like that before the end of the year?
I sure hope so. But first, you got to reopen the government. We're actually asking for, okay, how can we do this? How can we do that? The government shut down, so we can't get some of the information. The 7-week extension of the current budget allows that to happen. And so I'd ask Schumer to reopen the government. In the meantime, I'm certainly committed to how we can lower healthcare costs for all Americans. It's what I've been doing my whole life. And so let's get on it.
Senator, when it comes to moderate Democrats, do you see any willingness of some of them to join the three that we have seen sign up and vote for a clear stopgap funding measure?
I've not spoken to any of them personally. You'd like to think so. One more time, we've just asked for a 7-week extension of the current budget, which was done 13 times under Joe Biden. And so I would hope they would, because this is inflicting pain on the American people, but we could be talking with each other without a shutdown. I think this is a political response by Schumer to pressure from his left wing, but it should be pressure from the American people, keeping the government open while we continue to work to lower health care costs.
Senator, the White House is still operational and they've been making moves. I wanted to squeeze this in because I know you're a busy man this morning. Trilogy Metals in early trading this morning is higher by more than 200%. The announcement that the US will be taking a 10% stake in the Canadian minerals explorer, leading to a big rally on the stock. Senator, can you give me your opinion, your perspective on what you think of the party moving towards something that smells a little bit like central planning?
Yeah, I'm a little bit personally concerned about state-owned enterprises because it's a slippery slope. At first, you're a passive partner. It's one thing to have a position in the stock market, or it's another thing to have a timed exit. After TARP, there were some positions that the federal government had that was a timed exit. That's okay. But having a long-term interest, I think there'll be a future Democratic president who will be tempted to go a little bit further. We should definitely get a return on our investment if we end up bailing somebody out. Absolutely. But on the other hand, I'm a little bit nervous about taking positions that go beyond a timed exit.
Well, what do you make of the fact that the Republican Party, not the Democratic Party, is the party doing this and supporting state capitalism?
Yeah, so I think the president, I can't speak for the president, and the Republican Party is a diverse organization. I'll say that as well. I'm just speaking for Bill Cassidy, and I am a conservative. And I'm a little bit nervous when government ends up owning the means of production. When that happens, sometimes the government ends up dictating to the means of production what to do. For example, keep employment up for political reasons. I'm nervous about that. Maybe the president's got a great plan. It's one thing to be a passive partner, to own stock, we have a timed exit, et cetera. Another to be active. Now, I will say the president's specifically saying will not take a position on the board. That's my understanding. That's a good thing. That's a really good thing. But still, I'll put all those caveats out there.
As a senator, does it concern you that the executive branch is going one way and not consulting you and your colleagues?
Ultimately, we have to recognize that executive orders have been put there and the presidents can do kind of what they want with an executive order. But obviously, the problem with that is that when a new president comes in, she or he, so far just he, can immediately reverse all those. So you want legislation that will actually put in place for certainty for business and for labor that plan for the economy that goes forward. So everybody understands executive orders are powerful, but they're temporary. I would suggest that we're going to have long-term certainty. We need Congress to weigh in.
Senator, before you go, can Tigers football get back on track?
Can who?
Can Tigers football get back on track?
Oh my gosh, I certainly hope so. I certainly hope so. We'll have a good game that's coming up with South Carolina. So I'm always hopeful for the Tigers. Go Tigers.
Ole Miss on top of the SEC. Senator, appreciate your time. Thank you, sir. Senator Bill Cassidy, thank you, sir. Thank you very much. Had to squeeze in some Tigers football.
Tigers. You had to end this segment on a sour note. The poor senator.
At least he was very open about the situation when it comes to acquisitions. Very much so. And we talked about this in the previous hour with Libby Cantrill. I am sympathetic with the objective, uncomfortable with central planning, and ultimately you have to be wary of what you normalise when you're in power, because someone else might be in power and you might be out of it, and they can take this to a different place.
What Senator Cassidy said is what a lot of Republicans will tell me behind the scenes, but don't want to be so overt about it. And he was happy to be honest right there on live television about this does make him uncomfortable. And for those reasons you just outlined. How many times, though, have we seen administrations, this is taking it more to the extreme, but also the Biden administration, using national security as this veil to basically enact some sort of industrial policy?
That stock is up by 250% in the pre-market. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Dell shares soaring in the pre-market after it roughly doubled its sales growth and profit estimates over the next 2 years, citing demand for artificial intelligence products. The company's updated financial framework calls for sales to rise at a rate of 7 to 9% annually for the next 4 years, while earnings per share will increase 15% or more. Elsewhere, the International Energy Agency slashed its forecast of US renewable energy growth by 2030 in half. The reduction compared to last year's analysis is due to several policy changes imposed under President Donald Trump, the IEA said. Global renewable power is expected to increase by 4,600 gigawatts by the end of the decade, according to the report. And Tesla plans to unveil a cheaper version of the Model Y today to counter the loss of US incentives for electric vehicles. The cheaper vehicle will lack certain features and use less premium materials. Executives said that production of a more affordable model started in June, but they decided to put off ramping up output until after the US phased out tax credits. And that should be my brief. John.
Hey, Lizzie, thanks for this morning. Appreciate it. Up next, we'll catch up with Ohsung Kwon of Wells Fargo with a new 2026 year-end target on the S&P 500. Plus, Yahira has your morning movers. Dow soaring as AI demand lifts profit estimates. That stock is up by 5%.
Pretty easy for us to find great leases from investment grade tenants like the hyperscalers. You look historically in areas like this over the last 20 or 30 years, typically when this much capacity comes online, some of it at the end of the day is going to have to be marginal, right? These trends tend to lead to overbuilds in certain places, so I think us being selective and being measured in what we build.
That was the Ares Management co-president Kipp deVeer sitting down with Lisa a little bit earlier on this morning. That's the major theme right now driving this equity market. Futures right now on the S&P 500 shaping up as follows. Futures positive by 0.1% on the S&P, up by 0.2% on the Nasdaq 100. All-time highs at the close in yesterday's session, and we add some weight to the rally so far this morning. In the pre-market, let's get you some single names, some morning movers. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. We start with IBM rising nearly 3% in the pre-market on news that it's integrating Anthropic's Claude AI models into its coding platform. It's the latest strategic partnership between one of these established tech players and AI newcomers like Anthropic, which has been riding high. It just had a funding round last week, which nearly tripled its valuation to $183 billion. And another high flyer is Dell Technologies, up nearly 6% in the pre-market after the company roughly doubled its growth estimate for the next 2 years, citing booming demand for its AI products. And it has to do with what Chief Operating Officer Jeff Clark said, which is we were all wrong about how big we thought the AI market was 2 years ago, and it's nothing but bigger, he said. And we end on Trilogy Metals up now 250% on news that the U.S. is taking a 10% stake in the company, part of a $35 million push to unlock critical energy and mining projects in Alaska. Of course, it's the latest move by the Trump White House to take direct stakes in these critical minerals firms to counter China. John?
Yahara, thank you. Thanks for this morning. Major rally on that name in the pre-market. Let's stay on top of the market. Tech stocks fueling equities to a 7th consecutive day of gains. Ohsung Kwon of Wells Fargo expecting the S&P to hit 7,200 by end of next year, right in the following. The AI investment cycle could be as big as the internet cycle, if not bigger, requiring much more compute power than past innovation cycles. Ohsung joins us now for more. Good morning, sir. And congratulations as well.
Thank you.
On the new seat. Fantastic to get some time with you. Let's go through the note. Let's talk about where the money's coming from and what's fueling this infrastructure rollout, because that's important, and you've touched on that. Where's it coming from?
Yeah, so far it's been cash from operations, and I think that was really the early innings of the AI CapEx cycle. It was really the hyperscalers laying out their CapEx plans and funding it with their operations. I think now we're moving into the 4th inning, so essentially the first inning of the middle innings, that more players are coming in. They're tapping into capital markets to fund growth. And I think we could potentially see some acceleration in CapEx.
Is this somewhere we start to add the leverage to the cycle?
Yeah, exactly. I think that cycle could potentially lead into hyperscalers, potentially increasing their CapEx as percentage of operating cash flow. There are some concerns out there that CapEx as percentage of operating cash flow for hyperscalers are rising too fast, too much. If you look at consensus numbers, it's going to reach about 70% by the end of next year. We actually looked at what happened during the shale days with energy companies. I think that was the most recent example of the investment cycle. And during the shale days, energy companies spent about 90% of their cash flow on CapEx for 2+ years, and yet their stocks continue to rally. So I think as long as the equity market continues to reward their CapEx outlook and the growth outlook, I think this is going to continue.
But not everyone made it when it comes to the shale, right? Not
right,
everyone made it, .com, shale. So how do you, in this moment, decipher who's going to be a winner and who's going to be a loser?
Yeah, I think for now, at least, the biggest winners are going to continue to be the CapEx takers, so semis and hardware. And I think we are still in the earlier part of the investment cycle. So if you look at the size of tech equipment spend as percentage of total GDP, right now we're at about 2.0% of total US GDP. It peaked at 2.6% during the PC boom in the 80s, 2.9% during 2000, during the internet bubble. And just to get to that 2.9%, that means tech equipment spend has to go up by 47% on top of GDP growth, which is very significant.
Does it concern you, though, and we ask all these guests about this when it comes to AMD and OpenAI, NVIDIA, OpenAI, how circular this whole investment cycle is?
Yeah, there's a little bit of froth around that, obviously. What's happening right now is really, and this is a part of the reasons why we like small cap technology stocks that are really starting to see the benefits of this, ever increasing cycle of the AI CapEx investments. The idea is that the major players are at full capacity. They can't take capacity anymore. And because of power, GPUs, things like that. And they gotta make acquisitions, they gotta make investments in other companies to get that power and capacity. And there are a lot of small cap tech companies that are benefiting from it.
This is a somewhat original point of yours, that this can broaden down market cap, and that you also believe that the move in the Russell 2000 is not just about a rate story. It's not just about the cycle. It's about something with regards to AI. Could you give us some detail on that?
Yeah, so over the past 2 months, the Russell 2000 outperformed the NASDAQ. And a lot of people were saying that this is the cyclical rotation, this is the easing cycle trade, which I think a part of it is true. But if you look at what drove the Russell to higher over the past 2 months, it was really tech. It was communication services and tech that by far outperformed the Russell 2 index. So I think it was actually an AI story that because the big guys are at full capacity, there are a lot of smaller companies that are starting to really benefit from that because demand outpaces supply right now.
There's a guest who comes on this program, always challenges people to name a stock on the Russell 2000. A lot of people failed that task. Given it's an index that very few people can actually name the stocks on that index, how should you play that story if you are going down cap?
Yeah, so we came up with 26 stocks. We created a basket of small cap AI stocks that could potentially benefit from what's been happening over the past month or so.
Lots to think about. 7,200. Given everything you've just said, why are you so bearish? 7,200 on the S&P.
I mean, if you have to push me, I think there is more upside to our target, 7,200. But I mean, that's still about 8% upside from here.
For year-end next year?
Over the next 12 months. Yeah, I mean, we rallied 25%
You're
per year
describing a
over the past
melt-up,
years.
though. When you talk, what I hear is a melt-up. That's what I'm hearing.
So outside of AI, there's not that many stocks or sectors that I'm getting interested or excited about, maybe other than financials. So I think it's going to be a continuation of this narrow market. AI is going to carry the market, but our model suggests about 7,200 by year-end next year.
This was thoughtful. Appreciate your time. It's a great note. I'm reading it right now. Thank you, sir. Thank you. Ohsung Kwon there of Wells Fargo. 7,200 on the S&P 500 year-end next year. But going through the details on the AI theme, pretty bullish on where we are. The leverage is the next stage of things.
Yeah, the fourth inning going into the fifth inning, very Dan Ives-like. But Dan Ives will focus on the godfather of AI, where basically what we have here is focusing on all those companies downstream that are part of the AI story, but are not the mega tech spenders.
S&P futures this morning up by 0.1%. The open about 34 minutes away. Coming up tomorrow, Julian Emmanuel of Evercore, Torsten Slock of Apollo, Tom Becker of BlackRock, and the former Federal Reserve Vice Chair, Richard Clarida from New York City this morning. Good morning to you all. Have a wonderful day. Thank you very much for choosing Bloomberg TV. You've been watching Bloomberg Surveillance.